little bit of timing issues. Bienvenue, bonjour, to this 12th edition of the Swiss Mining Conference organized by the Bally's. I want to thank you for your presence. My name is Eric Lemieux. I'm a mining analyst based in Montreal, Québec. Alors, quand je vais m'exprimer en français, vous allez voir mon petit patois québécois que j'ai difficulté à cacher, même dans la salle de bain, et voilà. I want to welcome you again for this conference. We have a great roster of company CEOs and representatives that will give us insights on different commodities, on different projects all over the world. Our first conferencer is Monsieur Claude Béget, who's going to talk about us about the gold market and buy the dips. Claude suggested to me to ask the crowd right initially or at the end, you know, people, how do you feel about, have we hit the bottom in terms of the price of gold, or can we see more dips? And I'm just going to raise or ask you, as just a raise your hand for people who think that we've hit the bottom for the gold price. So feel free to vote, if I can say. Ladies and gentlemen, are we seeing the bottom of the price of gold? Any yays? That means all the rest is nays. So I'm going to ask you to do the exercise. If it's nay, put your hands up. Claude, you took note of that? Anyways, Claude is a private investor, an astute one, because he looks at the mining stocks, knows when to go in and when to go out. It hasn't been easy. Just very, very briefly, he's a graduate from the School of Business from Paris, has degrees in philosophy, psychology, sociology. I mix them up a little bit, but having said that, I have the honor of presenting Claude as one of our keynote speakers. So Claude, the floor is yours.
Eric, thank you very much. Good morning, ladies and gentlemen, and welcome to this 12th edition of the Swiss Mining Conference. It's one of the best conferences I attend because it's quality, it's small, it's quaint, and there's a lot of terrific companies, as we'll see. So, it's the third time I'm speaking here. The first time, I can tell you I was pretty depressed. It was November 2015, and I tried to put a good face in front of the audience, and I was so desperate that I said, well, prices are so low, forget about everything, forget about timing, just buy and hold. And it's true that when value is so low, then it doesn't matter if you have to wait, 1 year, 2 year, or 3 year. You always end up making money. And the last conference, and I see a lot of familiar faces, it was March 2016, and my message there was also quite simple. The seniors had gone up a lot, so I said, load the truck on junior gold mines because they have more growth and their valuation were much, much lower than their senior peers. Today, I'm going to try and have also a simple message because I'm from France. I did too many studies in philosophy, this and that, so I tend to complicate things. Of course, now that I live in Switzerland, I try to be a little more pragmatic. So I'm going to try and keep things simple. As a reminder for myself, first of all, I believe we're still in a bull market, so the idea is simple. You buy the dips. We're going to go through a few things. I'll just remind us that gold is always a difficult market. It's always difficult to predict. But all the elements to confirm this bull market seems to be in place. And to my mind, the gold market is intact. Then I'll give you a few ideas on some technical details. And we'll see why this conference is great for stock picking. So the question is, do we have to be obsessed with all these correlations, these smart analysis, or should we just keep it as simple as possible and use common sense? If you look at long-term studies, you can see that there are no correlations that work all the time. The first person to have done very thorough studies on the subject was Amy Gassman, who was the star analyst, the star gold analyst in the 90s. And she showed that long-term, you had very few correlations that would work all the time. So in the 70s, you had oil going up. Every time oil was going up, gold was going up. And then all of a sudden, this beautiful, nice correlation broke down. Same with commodities. With real rates, the correlation is usually better, but you have exceptions also. And for the geopolitics, it's the same thing. We've had a recent example. Everybody thought that, including myself, that if Trump would be elected, then gold would go up. And what happened? Gold went down. So gold is a difficult animal to predict. If we look at, so this I think is a very important chart. It shows you that the inverse correlation between gold and the dollar has been working pretty well for the last 10 years, with correlations in 2011 minus 71, 12 minus 54, 13 minus 59, and so on. So today people are really obsessed with the link between the dollar and gold. I will tell you that this will not work all the time. So we mustn't be hung up on this small notion. So the question here now is, why is gold down? We've had a very severe correction. In fact, I got that really wrong last time I spoke to you in March. I really thought that now that the bull market was started, that things would be easy. And as we're seeing right now, things are not easy, and we've had just a pretty severe correction. So why is gold down? We always know after the fact, but today it seems that what people are saying is that it's because of risk on, a strong dollar, rising interest rate, and massive hedge fund liquidation. Risk on. So Donald Trump, there's a new president, so we have hope. A lot of people believe that it could be a new Reagan, so it's risk on, you buy the stock market. People are a little more skeptic, say, well, even if Trump is not fantastic, or even if he doesn't do all what he is supposed to do or he wants to do because of Congress or this or that, then people think, well, he might have a honeymoon period until, let's say, January when he takes office, or 100 days after January. And these Trump skeptics are also buying the stock market. So the Dow Jones is making new highs. But what I'd like to stress now is that the U.S. today, in 2016, is not the U.S. that Reagan saw when he came into power in 1981. First of all, before Reagan came to power, the dollar had gone down dramatically. The dollar was undervalued. Reagan comes in here in 81. The dollar goes up, and then Reagan figured it was too high, and he pushed the dollar down. So with Reagan, the dollar went up and down. So of course now Trump comes to power. Everybody says, well, maybe the dollar is going to go up, like with Reagan. But the dollar is already up 52% since 2008. So it's a little different. And also, the dollar is up. But the dollar is up against what? The dollar is up against the euro. Do we think the euro is a good currency? It might disappear in a couple of years. It's up against the yen. How good is the yen? It's backed by debt. Rising interest rates. So the question here is that we've had an amazingly long and unbelievably strong bull market in bonds. 34 years of a bull market. We've had interest rates started to go up. What does it mean? Is it predicting A stronger economy? Is this just correcting an amazing excess? Who knows? I tend to believe that we've seen the low in interest rates, and now we're going to have a pretty painful bear market in bonds. Now, is that negative for gold? Not necessarily. Nominal interest rates can go up, and gold can still be up. In the 70s, nominal rates went up something like 15%, and as you all know, we had a fantastic run on gold. There's been a lot of fund selling. The ETF, which had a huge inflow since January, have seen a decrease of 106 tons just recently. Of course, the commitment of trader numbers were very high, so there was a lot of bullishness in the market and a lot of bullish bets. So that had to be unwind. And then you had some famous investors like Stan Druckenmiller saying that he had sold all his gold, which is always a little worrying. Now, should we worry? We have to remember these guys are traders, and they're good traders. They can go in, they can go out. An example, we all know that Soros sold a lot of his gold in the third quarter. He got rid of GLD. What less people know is that on November 15th, he just bought 1.78 million shares of Barrick. So who's going to be right? Soros, who's buying American Barrick, or Stan Druckenmiller? And again, Stan Druckenmiller can change his ideas on a dime. I found a few words from Crispin Odey, one of the great hedge fund managers in London. He's had a bad spell recently, but I'm sure he's going to come back. He's saying, globalization, competition, internationalization are now firmly in retreat. Inflation and protectionism promise a future which is not kind to financial assets as QE and deflation has been. High asset prices now sit uncomfortably with the stated aims of the new thinking. How long can investors cling to the past when faced with new ideas? The new idea, ladies and gentlemen, is a very old idea. It's a bull market in gold. The bull case is still intact. After the bear, the bull. We'll see supply and demand, uncontrollable debt levels, low real interest rates, war on cash, overvalued dollar, geopolitical uncertainty. We've had a terrible bear market. We all remember this. Everybody remembers this. Gold was down 45%, and gold stock were devastated. The seniors were down 82%, intermediates 86%, royalty companies, which are supposed to be the creme of the creme, down 70%, junior producers 94%, developers 94%, explorers 96%. These are not real numbers. These are not indexes. It was computed by Paradigm. So we have to keep it really simple. The stock market, as we all know, is not rocket science. There's a bear market, and after there's a bull market. And these cycles are long cycles. We're impatient. We want things to move. We want to buy. We want to sell. But the reality is cycles take time. We've had a big bear. Now we're in for a big bull. In terms of the euro, the bull market started in 2014, and the last to have turned was the dollar, the gold expressed in dollar, where we saw the low in the fourth quarter of 2015. I wrote a little article for Le Temps in the euphoria of summer, so I figured that gold could well be at 2017 in 2017. I thought it would make a catchy title, Of course, I know I'm going to be wrong, so I'm not worried too much about it. But the trend is up. That's my point. So what is proper investment philosophy? Richard Russell, who was this famous old-timer of the Dow theory, he was always obsessed by the primary trend. If you got the primary trend right, all your investment would work. So the big essential question for Richard Russell was, for the stock market, are we in a bull market or are we in a bear market? Once that question is answered, things are easy. And you can make mistakes in a bull market, you are bailed out of your mistakes. If you're in a bear market and you're long, you're in deep trouble. So, based on common sense, we have to ask ourselves, are we in a bull or are we in a bear? If we're in a bull market, and if you're all here, I assume most of you believe this, then you buy the dips. This is an example. Unfortunately, I didn't participate in this wonderful bull, but Apple is up 25,000% since its IPO. But there's been devastating corrections. 81 minus 35%, 96 minus 35%, and on and on. But if you buy the dips, even if you don't buy at the bottom of the correction, you do extremely well. Common sense. Good demand fundamentals. Demand is going up. In 2003, the demand was 2,500 tons. 2015, 4,200 tons. The uptrend is going on because there's more wealth in middle-class emerging markets. They buy gold. Central banks are buying, they're continuing to buy, and investors in the West are massively gold is massively under-owned in the West. Most banks still have 0% allocation to gold. This means that once fear comes back, they'll be buying gold. Gold production, in my mind, peaked in 2015. Of course, this means that we don't know exactly the numbers, but the output could easily be down 10% in the next couple of years. There are less discoveries, less exploration expenditures, and much, much more regulations. Ask any CEO here the amount of time he's spending with lawyers and things like that. It is terribly complicated, and it's extremely difficult to put a new mine into production, and it takes a lot of time. Debt levels, you know the story. We've had growth for the last 7 years, so you would have expected that there would be a little less debt, and there is much, much more debt. The election of Trump means that you will still have more debt. Why? Because if he gets it his way, you'll have more fiscal stimulus, lower taxes, infrastructure spending, wall building and exercise in Mexico. All this costs money. It'll be debt financed. The trade imbalances in the world are still astronomical. The U.S. has a huge trade deficit with China. It has a huge trade deficit with Europe. So if the dollar was so undervalued, if the dollar had to go up so much, then why is there so much deficit with Europe? The dollar is not a good currency, and it's overvalued. Protectionism also is not a really great thing, and there's also huge imbalance, as you know, in Europe. How can South Europe be competitive with a strong euro? How can Italians or Greek sell their goods? So the euro, could disappear quite easily. There's been a pretty good correlation in the last 10 years between real rates and gold, but real rates are still around zero. That is not a problem for gold to go up in this context. War on cash. So as an example, I'm telling you what's happening in India. You all know that Prime Minister Modi banned the notes, the 500 rupee note and the 1,000 rupee note. Of course, he's doing that for all beautiful things. It's to fight terrorism, it's to fight corruption, it's to fight tax evasion, it's to get inflation under control. But we know these are all scapegoats. The reality is that India is corrupted, the government is corrupted, they're spending 27% of GDP, they're practically bankrupt, so he's playing around. Today in India, gold is up massively. It is tragic what's happening. So the only solution is here. The dollar, I think it's an overvalued hamburger. So you look at the Big Mac index, and you can see that the dollar is overvalued in a lot of Asian currencies. It's overvalued against Japan and many. If you take purchasing power parity, you'll have a similar exercise. Geopolitical uncertainties, I'm not going to go into that. You know the story. There's plenty of uncertainty, and that's good enough for gold to go up a bit. In the 70s, gold corrected nearly 70% before this huge bull run from $100 to $800. We've just had a little correction. It doesn't feel little in your portfolio, but it's a classic Fibonacci 50%. We could be now in a new bear trap. When I was, after I talked in November 2015, I said I was buying a lot of stock here. I felt very bad here because this seems to be a little blip, but that was a pretty big decline. Bear trap, immediately it went back up. Here you have a perfectly perfect, symmetrical head and shoulder pattern. Everybody knows this pattern. It just broke down the neckline, so you could imagine we're going back down to the low at 13. Maybe this is a bear trap again. We'll see in the next couple of days or week if it goes back up. I have the impression that in the Friday, not last, but the one before, 10 days ago, we've had, after the Trump election, 3 days of capitulation with huge volume. And this felt like capitulation. That might have been the bottom of this correction. So here you're in a good spot for stock picking. These are the companies that I suggested buying at my last conference in March here. And as you can see, these stocks went up dramatically. Victoria Gold plus 236%, Teranga plus 174, Almaden plus 162, and so on. Two of the companies that I mentioned that could be takeovers were taken over at substantial premiums. So why is it that here is a good place to go shopping? Well, there are, I think, two main ideas. One is that junior gold stocks outperform. Seniors are big, so it's difficult to grow when you're too big. And most of them are badly managed. They're bureaucracies. Juniors, you have more growth, and valuations are lower. And the second element is that it's difficult to come here. It costs money, there's jet lag. So I would say the better companies have the courage to come here to Geneva. Since the highs in June, we've had a major correction. The index GDX is down about 35%. So if we're in a bull market, we should be buying this dip. In gold mines, leverage is back because you've had massive restructuring. Costs are under control. The traumatic bear market is still present in the minds of the CEO, so they won't be doing too many dumb things before a long, long time. And the volatility is so big that a lot of people are going to be very, very reluctant to get in. I mean, after a 35% correction, you don't want to buy gold stocks. You should be buying gold stocks, but it's difficult. This means it's a bull market because it's the wall of worry. So most of the stocks I mentioned last time are still good buys because we've had a nice correction. The most conservative and maybe the most efficient way to buy the dip today is just to buy a good fund which outperforms on the upside. A good example for this is Gold 2000. They were up a stunning 214% since March. They've had a correction now. It's a good time to get back in. For those who want a little more excitement, which doesn't mean it's going to be more profitable, but who knows, here are a few examples of very leveraged propositions. Companies which have a huge deposit, but which are in no way economic today. But if gold is at $1,500 or $2,000, of course, this changes the perception. And preferably no production, because then you don't have production risks. Good example is Nova Gold, which presents here quite often. If gold doubles, it's easy for this stock to go up 10 times or 20 times. Exeter Resource, here you have a company that has 37.9 million ounces of gold. Yet their market cap is $80 million and they have $18 million in cash. This means you're paying gold in the ground, ladies and gentlemen, not $200, not $20, $2 an ounce in the ground. In a bull market, this does not last long. On top of that, management is top quality. They have defined a very nice 1.7 million ounce oxide resource with a good PEA that could produce 120,000 ounces within the next 5 years. And their NPV at 5% at $1,300 gold is $250 million. And they're in a good jurisdiction, Chile. Here again, buy the dip. It's down practically 50%. McEwen Mining. We all know that McEwen is a fantastic operator. He created Goldcorp, and now he has his own company. Funnily enough, it's called McEwen Mining. And he owns 25% of the shares. His salary has been increased dramatically. He used to take no salary. Now he takes a $1 salary per year. I like these type of companies. And this stock went from $1 straight to $5 in a matter of 6 months. It can and it will do it again. As usual in a bull market, in a gold bull market, silver outperformed gold. The reason is extremely simple. There is a huge stock of gold. We're talking about 170,000 tons of above ground stock. This means that production per year is 1.6% of that amount. Silver, there is no stock. So as soon as you have demand, you're in a type of a corner, and silver goes exponential. We saw that happen very recently until 2011 when silver hit $50. The silver gold ratio is very, very high. Silver is very cheap versus gold. The ratio is 70. It could easily go to 50. It could go to 15. A go-to stock is First Majestic. Keith Neumeier is a fantastic promoter. In a bull market, he makes this stock skyrocket. Max Silver, You know this company, it comes here very often. This is Ultimate Quality. They have a joint venture, as you know, with Fresnillo, and a great new discovery. Pan American Silver. This stock, which is a big, diversified silver company with a lot of different production sites, could double production. Why? Because they have a fantastic deposit in Argentina. So basically, since the brokers put zero valuation in Argentina because they don't have any permits, the day they will have permit, and with the new president and with Ross Beatty behind, I'm pretty sure that they'll have the permit within a year. So here you have a great silver company plus a free call on Argentina. Not a bad mix. Alexco Resources, one of the cheapest silver mines around. They were a producing mine, but the CEO, when he saw he was not making much money, he decided just to shut down the mine. Why deplete good silver at low prices? He prefers to wait, keep the value for the shareholders. He is renegotiating a deal with Silver Wheaton. Once this is done, the company can go back into production. It takes minimal money to get it back into production. It'll take something like 7 months. And they can produce easily 3 million ounces. On top of that, they've made a new discovery of an amazing area where they have 2 kilos per ton. So this will be an immensely profitable new mine. They have plenty of cash, and they're cash flow positive thanks to an environmental company. Balmoral Resources, market cap $100 million. Just their gold discovery could make that a $1 billion market cap. Strategic Metals, low risk project generator. Go for takeovers. Almaden Minerals, they have 5 million ounces in Mexico at $1,400, $1,500 gold. Somebody will take them over. It's an easy triple. Sabina Gold and Silver, you probably remember the fantastic voice of the CEO. He got the stock up. There has been a correction because of some ridiculous permitting issue, which will be resolved. The stock will be taken out quite soon. Victoria Gold, fully permitted, good PEA. I expect this thing to be maybe taken out before year end. It could double because the shareholders are really good and they'll not let this company go for a small premium. Orca Gold, high-grade gold discovery, 2 million ounces, North Sudan. The management is terrific. We're talking about the Regback mining team. You can buy this company today at the same price as the famous investor, Ross Beatty. Market cap is only $40 million and they have $20 million in cash. Pretty unbeatable. A few little micro caps just to tell you that it's important to have some money in exploration companies. Today they are not the flavor of the month, but they're really, really cheap. A few examples. One is here, BC Gold. You have Carlin Gold. It's from the Electrum Group. The market cap is $3 million, but nobody read that there has been a little news release saying that Barrick Gold will be investing $5 million to prove up a nice little discovery. Bravada Gold, $0.2, very cheap. And Cyprium Mining, where if you read a recent news release, there's been a new director, and his name is Peter McGaw. He's the famous geologist from Mag Silver. So here are a few ideas. Thank you very much for your attention. I wish you a really great conference. It's a good time to look at great companies because we should be buying the dip. Thank you very much.
Thank you, Claude. Not too sure we have time for questions. Claude, you got your cell phone over here. Claude. 80. Well, that's a mistake there. Yeah, I just made a big mistake. Is menu in the room? Yeah, I don't have the password. I'm sorry about that. Anyways, I'll introduce the next presentator. Mr. Anthony Tse, who's Managing Director of Galaxy Resources. It's an Australian listed company. Anthony has over 20 years of experience in high growth technologies, media, and also in the commodities. He's been Manager Director in the Greater China area and in the Asia Pacific. Sorry about that, Manu. I want to press escape, but okay, thank you. Yes, and I want to highlight that he is quite knowledgeable. No, wrong thing. With the lithium market, and so his presentation on Galaxy Resources Limited should give us a lot of insight on the lithium market. So Anthony, if you want to come up and give us a great presentation, there. Good morning. How are you? Good. So you know the do it.
Yep.
Excellent.
Good morning, ladies and gentlemen. I'm here today to share with everyone the latest developments in the lithium industry and importantly, the critical role that Galaxy is now playing into this very high growth and exciting market that we have in front of us. Galaxy, as Eric pointed out, is listed in Australia. We're an ASX 200 company. We are purely lithium focused. We're also very unique from a perspective that we're only one of two Western companies that actually have a diverse portfolio of assets. We actually have exposure to both hard rock and brine-based lithium assets. Our assets are located in Australia. That's where our mine going into production is, and also we have a brine asset in Argentina, and last but not least, we have another hard rock project in Canada. Mount Catlin, which is in Australia, is about to deliver its first shipment before the end of this year. We started commissioning ore through the plant over the last week or so. But our flagship development really is the Sal de Vida lithium and potash brine project in Argentina, which is actually very strategically located on the same salar as FMC Lithium. And for those of you who are familiar with the lithium industry, FMC is one of the top 3 global producers. As I mentioned, we have recently been included into the ASX 200 index. Our market cap is around the mid-600 range. We have a little around approximately $20 million in terms of pro forma net debt, and increasingly getting covered by a whole variety of institutions, Canaccord, Bell Potter, Baillie, Hartleys, and I believe also UBS is in the process of picking up coverage on us as well. Board and management, currently we own probably just under 6% of the company. As I mentioned, we have a very diverse asset portfolio, unique not only in its diversity, but the fact that we have actually existing production, as well as a very strong development pipeline through our assets in Argentina and Canada. Just to give you some perspective, over the last 20 years, in brine projects, there's literally only been about 4 or 5 projects being built throughout the world. And in the hard rock space, it's even less. There's only 3 projects that have been built, including ours, which are in production or about to go in production. So it's actually a very, very small circle, and we have a very good footprint globally. Historically, we did actually used to have another business in China. It was a lithium carbonate processing facility, which basically took our lithium concentrate from Australia and shipped it to China, where we would convert it into lithium carbonate. And lithium carbonate is one of the main feedstocks that is used in the production of lithium-ion batteries. It's used mainly in the cathode, but also in the production of the electrolyte for the lithium battery as well. Interestingly enough, Asia today represents close to 90% of all the lithium-ion battery manufacturing capacity in the world. China itself is probably somewhere in the region of 55%, closely followed by Japan and Korea. But actually, if you combine Japan and Korea and multiply it by another 1.5 times, it's still smaller than China. So increasingly, this is becoming a very strategic industry for China. And by definition, a lot of the lithium-ion battery value chain, when you go from not only the end user to the battery, to the battery materials, the cathode, the electrolyte, the separator, the anode production, much of that basically sits in North Asia. And that's why increasingly you're seeing more and more of the world's lithium units migrate to that part of the world. And through the Jiangsu operations that we actually used to own in China, we've been very fortunate to build up a very strong customer base of over 40 customers who produce all sorts of battery materials. So what is the demand and supply situation of the lithium market in the world today? Based on our estimates, 2015, the world consumed about 162,000 tons of lithium carbonate equivalent, which is our standard measurement of lithium in the industry. Out of that, China was the single largest consumer as a single market, 70,000 tons out of that, closely followed by Japan and Korea with 21 and 18,000 tons respectively. Out of that 70,000 tons, 70% of what China consumed actually ended up going into a battery. On a worldwide basis, that percentage is about 40%. So lithium is also used in many other traditional industrial applications, such as grease, ceramics, and glass. But lithium batteries, by far and large, is the highest growth sector and is likely to become the largest segment going forward. China also last year became the single largest producer of lithium compounds, not lithium resources, because interestingly enough, most of the lithium that gets produced in China, or lithium compounds that gets produced in China, close to 90% of those compounds actually have to come via feedstock that comes from overseas, either from Australia or from South America, which is a complete opposite situation to what it has in the rare earth industry. So China last year surpassed Chile with 70,000 tons of production. Chile historically has been the biggest producer, and now they're only at 57,000 tons. So off the back of that 162,000 tons going forward, what should we expect in terms of future growth? Well, between now and 2020, there's a whole range of broker estimates that are out there. But roughly speaking, they range somewhere between 120 to about 180,000 tons of incremental demand coming online. And so basically what that speaks to is somewhere in the region of additional 20 to 30,000 tons of demand will be coming online every single year. And so where is that demand being driven from? A lot of it is increasingly being driven from the electric vehicle and the hybrid vehicle industry. Historically, if you look at world output last year, probably somewhere in the region of 3/4 of the world's output was probably, in terms of lithium batteries, ended up in these things, consumer electronic devices like laptops and tablets. But increasingly, that quarter share through the auto sector is growing larger and larger. And mathematically that is happening because the format sizes of the batteries within the auto vehicles are so much larger than in the typical consumer electronic device. So just to put it in perspective, an iPad, the iPad, first generation iPad, was a 25 watt-hour battery. And I personally actually drive a Tesla. It's a very large battery. It's an 85 kilowatt-hour battery. But if we took a normal car, let's say, for example, a Nissan Leaf, that's a 24 kilowatt-hour battery as the first generation Nissan Leaf was. So literally you're talking about 1,000 iPads for each electric vehicle that we see on the road today. And so what you can probably imagine is that you don't actually need to sell a lot of electric vehicles to eat up a lot of lithium. And that scale keeps growing as well. So when we talk about a Nissan Leaf compared to, let's say, for example, a Tesla Model S, you're talking about 3 Nissan Leafs in one Model S in terms of battery size. But then there are also other vehicle types that are actually being developed to go electric. In China, a big growing sector are commercial vehicles and also public transport buses. In a commercial vehicle, you're talking about somewhere between 1.5 to 2 times the size of a Tesla inside a delivery van. And inside a bus, it's 3 times the size of a Tesla. So you're talking about 200 plus kilowatt hours for an electric bus in China. And currently there are 500,000 buses in China, and the government wants to convert about 200,000 of them to electric. They've probably got through about 70, 80,000 so far. So as you can see, mathematically, as the auto sector drives this electrification, we don't need to go to very, very high penetration rates of electrification in that auto sector. If you hit 5%, 10%, it's already a very, very big impact on the lithium industry. And so what I've tried to do on this particular page is measure that impact. And we can run all sorts of sensitivities on this. And what I decided to do was look at all of the country targets and see what they stated as their 2020 objectives to electrify their transportation. And as a total, it works out to be roughly about 18 million vehicles, of which there are about 1.2 million vehicles on the road as of 2015. So at the bottom part of that slide, you will see a table which basically says scenario 1 and scenario 2. And scenario 1 basically assumes a certain size of the battery in those vehicles, and scenario 2 is a slightly larger battery. And that battery size that we've assumed is only 30 kilowatt hours and 40 kilowatt hours. And roughly speaking, we would normally assume 0.8 of a kilogram to feed 1 kilowatt hour of energy storage. So by calculating all of that, we can actually measure the impact on the lithium demand side in terms of those vehicles being adopted and fully deployed. And we're talking about a range of somewhere in the region of 400 to 500,000 tons of lithium carbonate equivalent, off the back of 162,000 tons that the world produced last year. So clearly, there's going to be a gap. And in our view, I don't think it'll be very, very hard for those targets to be met 100% across the board. And one of the reasons is because the supply side is, at the moment, very lagged and very slow to respond. And why is that? One of the primary reasons is that, as we all know, within the mining and resources industries, is that projects take time to come online. And within the two categories of lithium projects, you have hard rock and brine. And typically, if you're going from a post-DFS, you're fully funded. If you're starting from a standing start into steady state production, you're taking somewhere in the region of about 2.5 to 3 years to get there. About a year and a half to construct your project, and then about another year to year and a half to go through commissioning and then into steady state production. So in a hard rock scenario, which is the best scenario that we can have because they're a lot quicker to get online, it's 2 to 3 years. Within a brine project, it's actually much more challenging. A brine project typically takes about 2.5 to 3 years to build, and then it takes another 3 years to actually ramp up. So you're talking about 6 years before that product comes online, assuming you are fully funded today. So what we tried to do on this particular side is look at the level of investment that's actually gone into the lithium industry and actually what it actually needs in order to bring that supply online to actually meet that demand and have a chance of at least balancing that demand over the next 3 to 5 years. And what we discovered was this. We had a look and opined on what were the next half a dozen projects to come online. And the total capex number that we arrived at was 2.3 billion Australian dollars, which is just under 2 billion US dollars. And then we actually looked back over the last 12 to 15 months and tried to figure out, well, exactly how much capital has been raised for these projects, within the whole public equity markets. And we also looked at the private transactions as well. And the number that we came up with was less than 500 million Australian dollars. So basically, the situation that we have on the supply side at the moment is a significant level of underinvestment in order to actually bring those projects online. For a start, I think between 2017 and 2019, the whole demand-supply situation remained very tight because many of those supply projects will not come online because as of today, they're not fully funded. And so what that's led to is a continued robustness in lithium pricing. The last time I was here was in March of this year, March 22nd, and lithium pricing had already started running at that point. It was probably at a slightly higher level than where we are today. And actually through Q2 of this year actually ran all the way to, if you're talking about hydroxide, north of $20,000 per ton. And carbonate was actually close to $20,000. Now that pricing, in particular in China, has actually come off a little bit, about 25 to 30%. So in China today, you're talking about 15 and 18,000 US dollars a ton net of VAT, okay, for carbonate and hydroxide respectively. But one of the interesting things that's happening in the lithium world at the moment is historically China used to be a price taker. So the South Americans, particularly the Chilean projects, used to set the price and China would follow. Now that China has become not only the largest consumer, but the largest producer of lithium compounds, China is now starting to exert its influence on setting price. Now, because 70% of what China actually produces is actually based off a hard rock feedstock, it obviously has to sell that at a higher price, because hard rock operating costs for a converter are actually higher to actually produce lithium than a brine project. So as a result, today we have a price level which is approximately 2.5 to 3 times the level of where we were at the beginning of 2015. And for the time being, probably over the next 2 or 3 years, in light of the fact that the supply response will still be a little bit lagged, we're probably going to continue to see some very robust pricing going forward for the next 2 or 3 years. I've talked a lot about China. It's very much a policy-driven country. So a lot of their targets are very lofty compared to the rest of the world. 5 million electric vehicles on the road by 2020, 200,000 buses, 50% of government fleet vehicles will have to be converted to electric by 2020. But the vehicle side is not the only place where the government is investing. Last year, the government plowed somewhere in the region of 30 billion renminbi into the new energy vehicle sector as by way of subsidies and all sorts of government funding. This year, a lot of that funding is now being redirected to charging stations. So the government has an ambition to actually deploy somewhere in the region of 4 million charging stations, close to 1-to-1 ratio for each vehicle that's on the road by the end of this decade. So this is, for China, it's a strategic imperative. It's less so about, being environmentally friendly, which is actually important, but for those of you who've actually traveled to China very regularly, and I go once or twice a month, and I lived in China for many years as well, China is becoming a very difficult place to live now because of a lot of the pollution in the major cities. And so the electrification of transportation is a big strategic imperative for China, notwithstanding the fact that electrifying their transport fleets also allows China to de-lever the over-reliance that they have on imported foreign oil, which is also a strategic imperative for them. Like I said, we're listed on the ASX, and some of you who have maybe followed a little bit about lithium may have also encountered a lot of noise. There are a lot of junior companies out there who, at least on the ASX, there are over 100 who all claim to have a lithium project. But actually, when you go through a box-ticking exercise to basically figure out how many of them are, permitted, have a resource against it, or even have a pre-feasibility study, feasibility study, or even anywhere near production, that list tends to get very, very short, very, very quickly. And so I will point you to the left-hand side of that chart to figure out who the final names on that list should be. So what do we have? We have the first of our projects is the Mount Cattlin project, which we recently made a 1.6 million ton expansion to. So that mine this year, in 2017, our production guidance is for 160,000 tons of lithium concentrate at a roughly kind of 5.5%. Now, this level of production is only starting at our fairly conservative guidance of a 50% yield. But throughout the course of next year, we'll anticipate that we'll be working that through to about 70% as the plant continues its optimization. In terms of cash flow, so far this year we've signed 45,000 tons at $600 a ton, and we've got commitments so far for 2017 of 120,000 tons of lithium concentrate. I've actually started my negotiations with offtake customers already to finalize pricing for 2017, but we're hopeful that we can aim for something which is close to a $400 margin off the top of that. So essentially something which has a 7 in front of it is where we're going from. So a continued kind of price increase on that lithium concentrate price going forward. So if you do the math on a pro forma basis, 160,000 tons, $400 per ton kind of margin, then you're looking at circa $64 million, which is about 85 Australian dollars at the operating level for Mount Cattlin in terms of operating cash flow. Our corporate overheads next year will probably be somewhere in the region of $7 to $8 million. So you're talking about $70+ million in terms of free cash flow next year. Through the history of Galaxy, we've also accumulated a lot of tax losses. We have over 214 million Australian dollars of tax losses. So hopefully we'll be able to operate for a good 2 or 3 years without having to pay any tax on that cash flow, and it will be a happy problem if we do actually have to start paying cash sooner rather than later. So if you look at the company's valuation today, and a lot of people ask me how to value Galaxy, given that we have a number of projects, one very, very simple way is ascribing 2/3 of the company's value to, let's say, our existing production asset, and a third to the other assets. And mathematically, you can turn it around any way you want. But on that basis, you're talking about 440, 450 market cap or value ascribed to the Mount Cattlin asset. So if the Mount Cattlin asset at the operating level is throwing off north of $80 million on a pro forma basis, that basically puts the Mount Cattlin asset, or at least the Galaxy valuation, at circa 5 mid-single digit cash flow, so around 5 and a bit times free cash flow. Obviously, you can run your own sensitivities, but that's basically kind of how we're being valued in the market at the moment. How far have we got on restarting operations? So we've basically started commissioning ore already. So there is product coming out of the plant, and essentially we are looking at making our first shipment out of Esperance Port to our customers in China by the end of December 2016. Next up is Sal de Vida. This is our flagship development project located in the Salta and Catamarca province of Argentina. It's also located in a region called the Puna, and in the industry it's also known as the Lithium Triangle. So the Lithium Triangle straddles Argentina, Chile, and Bolivia. And as I mentioned before, we sit on the same sala, the Sala del Hombre Muerto, which is actually the same sala where FMC has been operating over the last 20 years. So in terms of infrastructure for rail, road, gas pipeline, electricity, reagents, even soda ash, which actually has to come from Wyoming in the US, can be shipped down to Antofagasta. There's a direct rail link across the mountains through to Antofagasta, and that can deliver reagents to site. It's a very large project. It's a 40-year mine life, 1.1 million tons of lithium carbonate equivalent, and over 4 million tons of potash. We recently completed a formal revision of the DFS for this project earlier this year in August. That gave us 25,000 tons of design capacity on the production of lithium carbonate, 95,000 tons on potash, for a capital cost of $376 million US dollars. The ultimate NPV that we arrived at was 1.4 billion US dollars as a net present value on that particular project. How we're thinking about financing this project going forward is probably going to be a mix of debt and equity. We're looking at a range of a half to 2/3 of that 376 being financed through debt financing, either by way of project financing or ECA type of funding, with the remaining part coming through by way of an equity component. And we have several options that we can consider in terms of funding that equity component. First, we obviously have some organic cash flow from Mount Cattlin that we can deploy to fund that. Secondly, we have some discussions ongoing with off-takers with respect to the potential to secure some prepayments against the off-take from Sal de Vida. And last but not least, we obviously have had some approaches with respect to taking a strategic stake in Sal de Vida. So if we do consider going down that route, we could actually envisage a project sell down, which essentially will bring in sufficient enough capital to actually fund the equity component of the project, while still be able to retain control. The economics of the project are very strong. So cost of somewhere in the region of $3,369 US dollars per ton for production of lithium. That's before potash credits. We've assumed a very bearish potash price in our model, somewhere in the region of 210 to 220 per ton of potash. If we do actually add potash credits to that, that will probably reduce that OPEX by another $410. So very strong economics on a post-tax basis. Average through the life of the project will be throwing off somewhere north of 180 million US dollars in terms of post-tax cash flow. Last but not least, we have another little project in a region of Canada called James Bay. It's in the Quebec province, and it's a very mining-friendly province. This is also a very similar project to similar asset to Mount Cattlin, very coarse grade, very coarse spodumene. And essentially we will be looking to advance our DFS work on this project at the beginning of next year, with a view to finalizing that through the year and be in a position to make a final investment decision on how we want to take this project going forward towards the latter part of the year. Essentially, we have a couple of options. One option is obviously just to build the mine and produce concentrate. The other option, given our experience in building and running the Jiangsu operations in China, we do actually have a second option of not only building the mine, but also building a conversion facility in Canada, located close to the mine itself, with a view to actually producing carbonate or hydroxide for the North American market. So with that, thank you very much for your time today. Just to share with you, I think we have a lot of milestones and interesting developments for Galaxy going forward, and I look forward to being able to see you all again next time and report on our progress. Thanks very much.
Thank you very much. Maybe the time for one question while I make the transfer over here, and be careful if you want to go over here, Anthony. Is there any questions from the audience? Monsieur Despatie?
Can you think about doing production of industrial mineral if you don't actually grow it up?
Good question. On a typical commodity, normally what some projects actually do is you actually try and secure an offtake partner as an equity partner. So in a situation where you actually have some concerns about your ability to actually place that product in the market, it will be good to actually secure that offtake in advance. Two strategies for us. On the hard rock side, at the moment, there is literally very much a very strong, a very overwhelming shortage of hard rock material in the market at the moment. China is adding somewhere in the region of about 50, based on existing producers before additional producers, somewhere in the region of about 56,000 tons of additional conversion capacity that will come online in China. And based on the new entrants that I see in that market, another probably about 40,000 tons of conversion capacity. So you talk about 80 to 90,000 tons of conversion capacity that wants to be built in China and is being planned at the moment. That, in hard rock terms, is equivalent to about 700,000 tons of hard rock, of spodumene required to actually feed those plants at 100%. Based on what the market is seeing at the moment, out of that 80, 90,000 tons, you only really have two hard rock projects, which probably over the next couple of years will be the only suppliers into the market. One being Mount Cattlin, which is our project, and another one being Mount Marion. Together, they will probably produce somewhere between 40 to 50,000 tons of that lithium carbonate equivalent. So when I'm having offtake discussions at the moment, the interesting situation is that it's very much a seller's market. So if this was an IPO book build, the level of oversubscription that we have in the book build at the moment is somewhere in the region of 2.5 to 3. Okay, so what we're talking about, for every ton of material that we're looking to produce, we probably have demand for 2.5 to 3 tons. So on that basis, what we're looking to do at the moment is probably sign not only offtakes for next year, but options over our volume going forward over a more longer term. So that's what we're doing on the hard rock side. On the brine side, as I mentioned before, the overall demand within the electrification, the auto industry, is going to be so large and dwarf the existing supply pipeline that, again, not only do we feel that there's not going to be a problem actually placing that product. In fact, the problem is actually on the other side of the table, is that if you're an end user, if you're an automaker or a battery manufacturer, you would start being, and we've seen this, there is starting to be a level of concern about the ability to secure raw material for all of these batteries that they want to build going forward. So probably some of the stories that you would have heard are announcements by Volkswagen, who wants to be producing somewhere in the region of 2 to 3 million vehicles per year within the electric fleet by 2025. Well, that's a lot of lithium. That's anywhere between 60 to 90,000 tons of lithium. So if you look at the pipeline of supply at the moment, we still very much have a situation where there's probably going to be more demand than supply. And so, again, for us, I think it will be a reasonably straightforward process to actually place the offtake. The more strategic decision for us is actually who we place that offtake to. So obviously we would like to be working with partners who actually have a much more longer-term strategic vision in terms of their growth plans on the demand for lithium.
Okay. Hey, thank you again.
Thanks very much, Eric.
Great presentation.
Thanks.
So our next presentation is by Mr. Scott McLean, who's the president and CEO of transition metals listed on the Venture Exchange in Canada. Scott has a lot of experience, over 25 years of experience in exploration, 22 years with Falcon Bridge Limited. I want to highlight the fact that he was co-recipient of the Prospector of the Year Award of the PDAC back in 2004 for the Pacific Rim South discovery in the Sudbury Nickel Camp. So I would invite Scott to come and present an interesting project generator model, again here at Transition Metals. Bon matin. Move forward, and I believe I made a mistake there. Back, green button for pointer here.
Right, good morning, everybody. We heard from Claude that everybody should have some of the have an early explorer in their portfolio. These are the companies that are really have the real growth potential compared to the previous speaker that just spoke. Their market cap is at 600 million. This market cap's at 6 million. So there's a tremendous opportunity to get involved at early stage projects. We know that discovery intersection often drives the stock price to some of the highest values that the stock will see in a mining company's life. So we approach exploration. We're purely explorers. We've got a great track record of discovery. And we take the exploration format a little bit differently than traditional junior. We call it a project generator model. Many of you have probably heard of it. We'll talk a little bit about that today and then highlight a few of the projects that we have within this portfolio. The company is, as Eric mentioned, is traded on the TSXV. The symbol is XTM. We are a multi-commodity project generator. So we look at a number of different types of projects, but to boil that down, most of our success has been in the magmatic sulfide spectrum, that being nickel, copper, and the platinum group elements, as well as in gold. We also have some copper interests and some diamond interests. So just some of the highlights. We are an award-winning team. We mentioned one, Eric mentioned one award that we've received. The team has also received Ontario Discoverers of the Year in 2013 for our Sunday Lake discovery, as well as another Ontario Discovery of the Year award for the work at Seagull, which is another platinum group discovery. We're focused in Canada. We like this area. We've all worked in the area for many years. We've got a lot of experience. We think it's a safe jurisdiction. We understand it and work well there. We focus our exploration, although we have 30 projects, we kind of bundle those into 5 district plays. We're well funded by partners. We have deep relationships with a number of partners. They fund a lot of our efforts and bring a lot of extra expertise to the program. We own about 36% of a company called Sudbury Platinum Corporation. This was a spin-out company a number of years ago. It's done very well. It's focused on the Sudbury mining camp, so nickel, copper, and PGM targets. We're currently in the middle of an 18,000-meter drill program on one key brownfields project there. And we've just recently picked up a new project there that has a residual 10 million tons of resources on it, both in the indicated and inferred categories. A new company that we have ownership in is called Canadian Gold Miner. This is a company that's focused on gold exploration in the world-class Abitibi Gold District. We're currently assembling a dominant land package there on a couple of the key breaks in the camp, and have picked up a couple of new, more advanced stage projects that you'll hear about in the coming weeks. We are currently carrying out a private placement within this subsidiary called Canadian Gold Miner, and that's available to anybody who would like to hear more about it today at my desk, on my table. Looking at the share structure, as I mentioned, on a market cap basis, the company sits in and around that $6 million level. We've seen continuous increase over the year here, but if you look at your brochure, we really haven't seen that big inflection point yet that many of the other companies here have seen. We're waiting for those results to come in to be allowed that real kind of uptick to happen. We only have 33 million shares outstanding since we started the company back in 2008, have 33 million shares outstanding. And I also point out that your brochure is wrong with respect to our capital structure. We have no warrants out. Our fully diluted basis is 36 million shares outstanding, about $1.5 million in cash in the bank. I mean, that we don't really need a lot of cash in this company. We operate under a project generator model, which I'll explain a little bit more. But as a result, we do partner out projects, look for other funding from other sources, and don't need to keep a lot of residual cash. The other two companies that we operate, Sudbury Platinum and Canadian Gold Miner, they are operated more like a traditional junior, where we raise money through equity financings. As a result, the capital structure increases. We have a higher equity dilution in there. After 3 years, Sudbury Platinum has about 41 million shares outstanding. Canadian Gold Miner, after about 6 months or so, already has about 23 million shares outstanding. We have done recent financings in these two corporations. Sudbury Platinum raised about $3.5 million in the spring. It gave this a valuation of about $12.5 million based on that private company financing. Our ownership in it would be about $4.4 million in value. Canadian Gold Miner did its seed round at 10 cents, giving it a valuation of about $2 million. Our ownership is worth about 1.5. So I'll point out to everyone here, here's a great buy opportunity. If you run back, if you all rush out of the room here and get to your computers when the markets open up in North America, you can effectively go out and buy transition metals at a $6 million valuation, which is effectively equal to our subsidiary valuations that we're getting. And so everything else we have in the company, our other projects, our other partnerships, our other programs and people all come along for no charge. A great buy. So the project generator model, what makes it different than a traditional model? Well, first of all, we're in probably one of the highest risk investment areas in a mining company's life. It's really at that exploration stage. It gives you the highest reward often, but is also the highest risk. So we tend to try and mitigate that risk. We like to bring in partners to earn interest in the individual assets that we own rather than issuing equity and diluting on the equity side. This diversifies the risk. We have many projects out there, so many irons in the fire, many opportunities for shareholders to be involved in discoveries. It increases our probability of discovery, and it really leverages not only our partners' funding that they're bringing in, but also their expertise. As investors, often one of the harder parts of evaluating a company like this is understanding the technical merits of individual projects. And at least in this market where you see large companies, for example, one of our significant partners is Impala Platinum out of South Africa, the world's second biggest platinum producer. And when you see them partnering with us, you know that you've got some validation that a high level of due diligence has been done on the technical side. And as an investor, that can be helpful in making a decision of which company to invest in. But the biggest and the key thing about the project generator model is that we minimize the shareholders' equity dilution as much as possible. We keep the capital structure tight, and instead we dilute on the property interest side. So if we kind of put that into a table, if we look at a traditional junior, they typically only have 1 or 2 projects that they're working on. The funding comes solely from issuing equity or selling ownership in the company, and that creates a high rate of equity dilution. But it's a good scenario if you have a great success. The success scenario is that traditional junior has a single discovery. They own a high percentage of that discovery, which would be 80 or 100% perhaps. But you and I as shareholders have been severely diluted so that we own a very small piece of that large pie. A project generator has multiple projects on the go. Although it issues equity to kind of get the flywheel turning and give it a push once in a while, we do rely on partners to come in and provide the funding to earn interest in those assets. And that keeps our shareholders' equity dilution really low. So our success story is being involved in multiple discoveries, but probably having minority ownerships in those, or in some cases even royalties. The key thing, though, you and I as investors will have not been diluted on the equity side, and so we'll own a large piece of a number of smaller pieces of pies, if that makes sense. It's a great model for that mitigates risk for early stage explorers, and it's been a great model through the bear market that we've just come through. We've done very well. We've continued to explore, continued to drill, continued to discover through this period where many of our peers saw their valuations drop to, as you saw from Claude's presentation, down to 5% of their value, and had to go out and refinance the company at those crazy low valuations, which is unfortunate for the investors that invested at higher levels. So here's the company. It's complex when you look at it at first, but if you boil it down, it's pretty simple. The principal company is Transition Metals. That's the publicly traded company. We have about 9 partner agreements in place where people are earning into our projects. We have a number of projects that are available for options, and we're out there marketing those as we speak today, and you'll hear of new partnerships coming to bear over the next few weeks and months as we move forward into 2017. Sudbury Platinum, we originally owned 100% of the equity in this company. It focuses solely on the Sudbury nickel copper PGE mining camp. We have 2 significant projects there, one with a high level of resources. The other is probably one of the best exploration projects on the planet. I'm the salesman here today, but I really do believe it's an excellent project. And this company was originally spun out in 2013, November 2013, as a matter of fact, and we'll look to take this company public early in 2017. Our newest subsidiary is Canadian Gold Miner. That's solely focused on gold in the Abitibi. We've done a seed round financing back in July where we raised $500,000. We've now done some exploration with that money and brought in some very significant projects through stock deals. And now we are looking to finance this company with about $2 million, looking to take this public by the end of 2017 if we can do it with a higher IPO financing at that time. That private placement financing is available to folks here if they're interested. So where are our projects? Well, we're right across Canada. There's a lot of information on this slide. The key thing is we have a lot of projects in a lot of different commodities, but if you boil it down, we're in nickel copper PGEs, we are in gold type projects, and we have one significant copper project in Saskatchewan, which I'll give you a little information about in a few slides. Our subsidiaries are in Sudbury, with Sudbury Platinum, and our Abitibi company, Canadian Gold Miner, is in the just south of Kirkland Lake and Galganda areas of Ontario. In terms of people, we've got a great team. The core team includes myself, Greg Collins, and Grant Moore. We all work together at Falconbridge Limited and Extrata Nickel. We had great success in those companies, discovered a number of mines and a number of resources. In fact, when you total everything with the entire team, we've discovered about, when was the last count we did? I think it was about 62 million tons of resources worth about $50 billion of in-situ metal value. A lot of that coming within Falconbridge. We do have a number of awards, Prospector of the Year award for Canada and a couple of provincial discoveries of the year. So what are a couple of the key ways to look at these project generators? There's a niche group of them that are out there for you guys to choose from. And a couple of things you want to look at is not really how many projects they have out there, but a couple of things is what is the deal flow. That we live and die by the deal. That's what makes us successful. Are we able to market? Are we able to select projects that are marketable, that can attract good partnerships? So that's one of the key things you want to look at when you're comparing Transition Metals to other project generators is what is their deal flow, how many deals, what are the quality of those deals that they have. A couple of key partners we have in Palo, we mentioned them earlier. They've been with us since 2008. They're currently solely funding our discovery at Sunday Lake through to feasibility. Another key partnership is with Nunavut Resources Corporation. This is a Inuit-owned or Aboriginal-owned company in Nunavut, the Kitikmeot region of Nunavut, and at a time when the industry is dealing with many complicated indigenous issues around the world. This is a great partnership that we've developed where the Inuit are funding us $18 million over 5 years to generate projects on behalf of a strategic alliance that we're in with them. Another good thing to look at when you look at project generators is what is their expense to cost ratio. In 2016, our budget is about $4.7 million of exploration expenditures. We're probably going to get close to that. I don't think we're going to hit 4.7, but we're going to be over $4 million by the time we get to the end of this year. And the cost, as you can see, to us, to our shareholders, will be about $567,000. So our cost, it's costing us about 12% of the total bundle of exploration expenditures that are being employed into the projects this year. So we'll just take a look at a few of the projects, and happy to chat with anybody about any more details and other projects. This is just a picture of a new project, our newest acquisition up in Nunavut. It's called Arcadia Bay. It sits right on tidewater of the Coronation Gulf. This is a lode gold quartz vein system that can be seen from space. This is the biggest vein that we have. It's 4.2 kilometers long by about 50 meters wide in places, but on average about 20. It runs about 21 grams per ton over lengths up to about 8 meters in places. The rest of the property already has a historic non-compliant resource of about 200,000 ounces. So it's a really neat new project that we've picked up. Our key project, one of the key projects we're working on, is our Sunday Lake project, which is in Ontario, north of Thunder Bay. It's associated with a very large continental-sized regional geologic structure called the Mid-Continental Rift. The geological environment is very similar to Norilsk in Siberia, one of the world's biggest nickel-copper PGE camp, except this is a little older. There's been some really interesting discoveries this century, including Lundin's Eagle Mine in Michigan, and Rio Tinto Talon's Tamarack deposit, which will be put into production in Minnesota. Our projects are on the Ontario side or the Canadian side. Sunday Lake is by far the most advanced one at this point, which is a new discovery that we made in 2013. We're starting to case the first hole today, actually, on Saturday night, which is a Sunday Lake lookalike, and hopefully we've got another Sunday Lake tiger by the tail with Saturday night. The third one is Eva Quito. That's a large mineralized intrusion that we're looking for a partner for. If we look at Sunday Lake, this is the size of the intrusion. It's about 3.5 kilometers in size. We've drilled just along this one corridor in here where there's a funnel that's feeding the system into a large pool of ultramafic magma. The mineralized zone to date is about 800 meters by 400 meters in size and open in all directions. Our best intersection is about 43 meters at 3.5 grams platinum plus palladium, which includes about twice as much platinum than palladium, which is unusual. That intersection also included about a 10-meter intersection of about 6 grams per ton. Our copper project in Saskatchewan, we think this is a key project for a new partner. We've got a couple of groups looking at this right now, and actually this week we have folks up there looking at drill core from a major company. We hope they pick this up. It's a sedimentary hosted copper project. So this, in terms of where it sits, is just south of the Athabasca Basin, southeast of the Athabasca Basin. We have about a 25-kilometer strike length of ubiquitous disseminated calcite in red bed sediments. This is the only known analog that we can find worldwide to the giant Udokan deposit in Russia, which actually might be geologically connected to this. Udokan is about 26 million tons of contained copper, including out of about 3.1 billion tons of 1% copper. Everywhere there's outcrops, there's disseminated calcite. Our best grab samples run up to close to 10% copper, but generally speaking, we're looking for 10 to 30 meter intersections of about 1% copper. We think with the first $2 million employed on our drill program that we've planned, we can put the first 20 million tons of resources together. Sudbury Platinum, this is our subsidiary that we only own 36% of now. It's focused in the Sudbury mining camp. This is a notorious camp. It's been in production since 1883. It's produced about 1.6 billion tons of ore from 56 mines. The feature is a 60 by 30 kilometer meteorite impact site, and we have two projects. We have the Lockerbie East mine area, which has about 10 million tons of resources on it. And we've just put a news release out this week where we've done some geophysics down below the old mines, below the resources, and have really high grade, really high quality EM targets to chase. Notably, I'll point out to people, when I worked with Falconbridge, I sold this project for $8.6 million, and I bought it out. I threw a low bid into a bankruptcy auction for this property and was able to buy it back for $100,000 in cash and $100,000 worth of stock. So good lift there. The project that we're drilling right now is Air Kid. This is, as I mentioned, is probably one of the more important, one of the more interesting exploration projects on the planet. It sits in an offset dike, which is one of these dikes that come off the basin. The Coppercliff dike here, for example, has produced about 30% of Inco and Valley's production to date in the camp. I'll point out, to have any properties of this quality in a camp like Sudbury is unheard of in most cases. This camp is completely controlled by 3 producers. One is called Glencore, one is called Valley, and one is called KGHM, all with significant higher valuations than the company that I'm running. If we look at a long section along the dike looking to the northwest, I'll give you a flavor for this. This is our property, sits in here. This is surface, this is depth. Just off our property boundary is Totten, and just off to the southwest and to the northeast is Victoria. These were both mined in the latter parts of the last century, where they mined small discontinuous lenses near surface, and then went down dip on these, Inco in 1999, F&X in 2010, and discovered significant ore bodies at depth, which include Totten at 10 million tons, 1.5 nickel, 2 copper, and 5 grams, and platinum plus palladium. And then the jewelry box here, as I like to call it, 15 million tons, 2.5 nickel, 2.5 copper, and 8 grams platinum plus palladium. We have done borehole geophysics down below the workings in our property here, which were mined in late 1960s. And we have a number of high-quality EM features that we're now currently drilling off. I've come up with small resource in this area and currently drilling the deep, a panel of deep targets at depth, which you'll hear news of over the coming weeks here. The final projects I'll talk to you about is our other subsidiary called Canadian Gold Miner. We've assembled a dominant land package in one of the world's great gold camps in an area that hasn't been overly explored. We have about 165 square kilometers of quality properties there. We've just picked up the complete Nipissing, the Lincoln-Nipissing structure, which is a large 25-kilometer-long structure that hosts a number of not only old showings, but old shafts, pits, and past producers. We've picked up some advanced stage projects. One of them is called La Fonde. We'll be drilling that this year once we do our financing this year, early next year. And we've just picked up another significant advanced project from a major company that we'll announce in the coming weeks as well. In terms of exploration, we've carried out a little exploration at the Bjorkman showing on our Midlothian project this year. We've done mapping and sampling of a high-grade gold occurrence there that was known before. That occurrence ran up to 12,000 grams per ton, or 12 kilos per ton gold in hand samples. We've now taken a 1.5 ton sample out of that showing, which has returned 15 ounces of gold. So a small little occurrence at this point. We don't know much about it, but certainly high-grade opportunities in the camp. So this is where the projects sit. They sit along these significant breaks. This is Kirkland Lake up in here. This is the Matachewan Gold Camp here. Timmins would be sitting up under the A in strategic title here. The property position that we have, we're really excited about our dominant position down south of Kirkland Lake along the Lincoln-Nipissing structure. We have about 15 kilometers, the Cadillac Larder Break along strike from Young-Davidson that Alamos is currently mining, and that's where we just took our 1.5 ton sample. We have a number of other exploration projects on these breaks that I'd be happy to chat to you about. All have exciting exploration targets that need to be tested. So the financing that we're doing on that right now, we're looking to raise $2 million. We're selling units that include a half warrant at 25 cents. That's a common share and 1/2 warrant for 3 years at 30 cents. And we're, for the Canadian people that report Canadian income, we're also selling flow-through shares at 25 cents. So I'll just wrap it up here. We look at this as a great investment. I hope I've demonstrated to you that, it is a buy opportunity. The value we're getting for our subsidiaries through really good financings with, lead orders from resource capital funds and so on, is really demonstrating that we're undervalued in terms of our market cap that we get on the public markets. We're in 5 district plays. We operate under the project generator business model that's going to give you investors a much more, increase your chances of being involved in a discovery, but also mitigate your risk because we'll be utilizing partner funding. We have a brand new discovery at Sunday Lake. When you look around the world, there's not many new platinum discoveries being made. Here's one that has a significant intersection, a number of significant intersections, but certainly eye-popping to people that are looking for these types of opportunities. Our subsidiary in Sudbury is focused in Sudbury. That's our world-class mining camp. It's been around for centuries, we'll say. We're currently carrying out an 18,000-meter drill program. Expect good news flow coming from that, as well as we've just picked up a very significant new resource that we've carried out the geophysics on and are ready to start drilling. Subsidiary Canadian Gold Miner, that's our newest one. It's available for private placement if you're interested. Again, it's a private company, so if you buy this stock, you'll have to hold on to it probably for a minimum of 8 months, but maybe even a year. We do have a fantastic strategic alliance in Nunavut. We're getting funded by an Aboriginal group, the Kitikmeot Inuit, through their wholly owned company called Nunavut Resources Corporation. We think this is a great buy. We hope that you all rush out and buy some stock today, and thank you very much.
Multi-opportunities and multi-talent. Thank you very much, Scott. Our next presentation is Pure Gold Mining. I have the honor of presenting Mr. Darren Lebrenz, who's the President and CEO since 5 years now. Darren is a professional geologist, has a lot of experience having worked with Placer Dome, I believe in Nevada, Tanzania, and particularly in the Red Lake District. And he was chief geologist, I believe, for the Campbell Mine. I'm going to keep it short because we're running a little bit late, but I just want to make a little statement. I love their statement. I trafficked it a little bit, but they dream big and color outside the plunge lines. Darren? Good morning. Thank you. Move forward. The pointer is this one. Okay. Excellent. Good presentation. Thanks.
Morning, ladies and gentlemen. I'm here today to introduce you to Red Lake, Ontario. As Eric said, I did work in Red Lake at the Campbell Mine. It was about 20 years ago today, and I was working underground, and I learned a new term. They called it 10-foot gold. So what does that mean? Well, every day we'd go underground, we'd walk underground, we'd go to the drifts, and we'd see what had been blasted out from the day before. And every round you took or every advance you made underground was 10 feet. They drilled 10 feet, they blast it down. We'd go down, we'd wash the face and the back and scale it off, and you could see the gold from 10 feet away. And it's a pretty remarkable thing. I went over the next 20 years of my career, and it's really incredibly rare to find grades like that. So at the same time, 20 years ago, there was a brand new company just across the fence. It was mining the exact same ore body. That company was Goldcorp. And so Goldcorp was founded by Rob McEwen in Red Lake on the Red Lake mine. And it was a fledgling company, but they were in the early stages in 1996 of drilling off what would ultimately become the high-grade zone. The high-grade zone sat in the footprint of the Dickinson mine for 50 years before it was discovered. And it fundamentally transformed that mine. They went from 50,000 ounces a year to, once they developed the high-grade zone, to producing 600,000 ounces in a single year. It was a grade of 60 grams per ton, or 2 ounces per ton, and that launched Goldcorp. Goldcorp is the senior producer that it is today because of that discovery in the Red Lake camp. So that is the opportunity of this Red Lake camp. We'll fast forward now to 2012, and I was managing an early stage exploration company and having some difficulty attracting attention. We're in the midst of what we've talked about earlier today, but in the midst of a bear market, and frankly nobody wanted to hear about early stage exploration. So I sat down with Marc Audet. Marc Audet is well known to many people in this crowd. He's the founder of Frontier Gold, of Aurora Energy, True Gold, which is presented here before. So what may be less well known is he also had his origins or his start in the Red Lake camp. So we're talking about what kind of project we could bring into the company. What could we build a company around? Something that could survive in difficult markets as well as thrive in buoyant markets. And so we built a bit of a checklist, and number one was high grade. We wanted to acquire a project that was very high grade. Secondly, we wanted to be in a good, strong, mining-friendly jurisdiction. We wanted to have access to infrastructure. So we wanted to be able to move a project forward on a year-round basis and move it quickly towards production. And so we bounced around a lot of different ideas, and ultimately we came back to what we knew best, and that was Red Lake. And so went out in 2012 to pursue the Madsen Gold Project. It was a long pursuit. It took about 18 months before we ultimately were successful in acquiring the project. And in the end, we paid $11.2 million in cash and stock. Difficult markets often bring good opportunities. So what did we acquire for $11.2 million? Well, we acquired the past producing Madsen Gold Project. Produced 2.5 million ounces historically at a grade of 10 grams per ton. It's the second largest past producer in the Red Lake camp. The land position, 45 square kilometers, makes us the third largest landholder in the Red Lake camp. It also comes with a current resource of 1.2 million ounces at 10 grams per ton. That includes 900,000 ounces of indicated at just under 9 grams and 300,000 ounces of inferred at 11.7 grams per ton. It comes with infrastructure. That includes a 550 ton per day mill. It includes a shaft down to 1.2 kilometers and 67 kilometers of underground workings. And it also includes a tailings facility. And what's more is the project is permitted as a mine currently under temporary suspension. So what does that mean? Well, the mill is not currently operating. We're not producing gold, but we have that permit to move forward back into a producing state in a relatively straightforward fashion. So we acquired the project with a view that the Madsen project also had fantastic opportunity for new discovery. And I'll walk you through why I feel even stronger now today that is true. So the first thing we did was we wrapped together a pretty strong technical team. If you look through there, you'll see a common theme, and that is Red Lake experience. Very strong technically in Red Lake. When you look at the board and management team, collectively over the last 5 years, have been involved in over $5 billion in M&A activities. So also very strong on the strategic and capital markets side. From a share structure perspective, 170 million shares issued and outstanding. The project was acquired through a financing. It was $18.6 million raised. It was a 25-cent unit financing. All of the board and management participated in that initial financing. It came with a half warrant priced at 50 cents. That warrant was set to expire in September this year, and we had near 100% conversion. That brought in $19 million in cash proceeds, and so we're well financed to move the project forward. Key strategic shareholders include AngloGold Ashanti at 12% and Rob McEwen personally at just over 10%. So this is where we're located. It is Red Lake, Ontario. It is a relatively small camp, but it's produced 28 million ounces of gold historically over an 85-year mining history. It is the highest grade gold belt in Canada and arguably in North America. Primary producers owned by Goldcorp are to the north, the Campbell Mine, the Red Lake Mine, and Koshner Mine. We sit on the south end of the camp, centered on the Madsen Gold Project. We also have the Stuart Olson Mine on our property. And we feel that the south end of the camp has seen significantly less exploration and thus presents the opportunity. We've got a photo here of the site. You can see in the foreground, the blue building there is the mill. It's not the original mill. It was acquired in the late 1990s and moved to site. It's a simple mill, SAG mill, ball mill, leach circuit with CIP finish. Behind that or beyond that, you see the head frame sits over top of an underground ore body that would run left to right across the page. To the right side, just off of this image, is the tailings facility, and to the left, just off the image, would be a portal with a ramp. Some more shots of the infrastructure here, the interior of the mill in the top right, tailings facility in the bottom right. Portal is shown in the top left. I highlight that because I'll talk a little bit later in the presentation about a preliminary economic assessment that we put out earlier this year. And that envisions taking that ramp and pushing it down to 600 meters. Currently has a rock cover on it, which you can see right now, and we've recently applied for permitting to remove that rock cover. We anticipate having approval to do so in December, and then next year we'll be underground, reestablishing mine services and launching an underground exploration program as well as a surface exploration program. Resource is shown here. This resource is defined by 13,500 historic drill holes. The average spacing underground is 7.5 meters. Geological model is built from 24 levels of underground mapping, and so we feel very, very comfortable with the resource that you see here. So we'll step into some of the, what I see as the high-grade geological opportunity in the property. We're showing a property outline here with a black line, again 45 square kilometers. I highlight two features on here. There's a thin red dashed line that bisects the property. This is a important feature in the camp. It's a structure, it's a gold-bearing structure, and you want to be near it. So when you look on our property from, as you move from south to north, you start at the south end, you have the Sterret Olsen mine. That produced for 8 years, it last produced in 1956. The Madsen mine, sitting in the center, as I said, second largest past producer, was a successful mine. It produced for 36 years. Last substantive production was in the mid-1970s. There was an attempt at a restart in the late 90s, but as we all know, gold prices were very depressed at that time. Move up beyond that towards the north, you have the Howie and Hasaga mines. These are the first mines in the Red Lake camp. You want to be very close to this structure. I also highlighted a dark-colored unit there. It's called an ultramafic. It's not really important. What is important is the high-grade zone that I described earlier at the Red Lake mine lay along the contact of one of these rock units. We think it's highly prospective, and we think there's evidence at Madsen for a similar style of mineralization. And I'll show that in the next slide. So the next slide I'll show will be a cross-section. It means it's a slice through the earth. We're going to be looking towards the north, and it runs through that dark-colored unit and through the Madsen mine. So on here, we identify all the key features. This is a cartoon. It's simplified, and everything's projected onto the plane. You can see that big gold-bearing structure off to the right, labeled the unconformity. Just to the left of that, in the footwall, as we call it, is the Austin. The Austin Horizon was the key producer at the Madsen mine. It produced for 36 years, well over 2 million ounces from surface down to a depth of 1.2 kilometers. Now, what you don't see on here is that, and this speaks to what Eric introduced as coloring outside the lines and outside the plunge lines. What you don't see here is that Austin Horizon plunges to the north. So what that means is in 1930s, when they discovered the ore body, they put the shaft right on top of the ore body. And this one actually worked. They started to mine and was successful, as I said. But as they mined deeper in the mine, that Austin moved further and further out of this image towards the north. So at the bottom of the shaft, 1.2 kilometers down, they had to drift 2.5 kilometers to the north to access the Austin. And that's why the mine shut down. It was the time that it took to develop out to the Austin and the cost of capital to develop out to the Austin. The ore body is open to depth. There's mining down below the bottom here that suggests it's open, and we have a deep drill hole that intersected the Austin at 2 kilometers below surface, returning half-ounce grades in that Austin Horizon. And that is significant. When you think about the high-grade zone at the Red Lake mine, it actually started below a depth of 1.2 kilometers. They're currently mining there at 2.5 kilometers. So that's a real opportunity, but it's an opportunity for the future. Because it's very expensive to explore at that kind of depth. What we did is we had a look at the footwall where we have labeled here the McVeigh Horizon. Now the McVeigh is a parallel ore body, parallel to the Austin. It looks identical, and it was only mined historically to an average 100-meter depth. So about 1.5 years ago, I asked the team to explain two things. I wanted to explain, why does the Austin plunge to the north? Why does it move forward to the north as you go deeper? Secondly, I wanted them to try and explain, why was the McVeigh only mined historically to a depth of 100 meters? So they first looked at the Austin, and it was a geological question, but it was pretty simple. You have a group of rocks that the gold wants to be in. It's intersected by a gold-bearing structure, and that intersection line runs north. So we could explain it. But what they found was that same intersection line in the McVeigh runs south. So that was a key understanding, a key breakthrough in terms of our understanding. The Austin plunges to the north, the McVeigh plunges to the south, and so with every step they went deeper in the Austin, they were leaving the McVeigh further and further behind. So we call it the missing half of the ore body. We started drilling that early this year, and the first holes proved the concept. We've now demonstrated that the south plunge is real within the McVeigh, and we've continued to become more aggressive with our drilling as our certainty has become stronger. We're currently in the midst of a 4-rig, 77,000-meter drill program with a goal of adding additional resource near surface and within the footprint of the ramp that you can see on this slide. So before I step away from this, I'll also talk about the 8th zone resource that you see towards the bottom of this image. The 8th zone is Madsen's version of the high-grade zone. It sits in that same environment, the same geological environment that hosts the high-grade zone. It's there, it's in situ, it's 300,000 ounces running 15 grams per ton. Now, our predecessors spent a lot of time and money exploring and looking to expand that 8 zone at depth. They went underground, they dewatered the shaft, they were on 16 level drilling it off. We took a very different approach. We said, if it exists at depth, why couldn't it exist closer to surface? And so we pointed it up towards surface, went and looked on the ground and saw a lot of things that we wanted to see. We put the first modern drill holes into the area we've labeled here Russet South in February of last year. Our first hole was 3.5 meters and 9.5 grams. The second hole was 11 meters at 8 grams. These are both 75 meters below surface. We stepped 200 meters to the south while we were trying to figure out what we had hit, and we drilled 3 meters at 40 grams per ton, sitting 10 meters downhole, effectively right at surface. And, importantly, on the same contact, 1.6 kilometers up plunge of the 8 zone at depth. And so another very exciting discovery for us. So I'll step back now to the McVeigh, and I'll show an image here that tries to show what I tried to explain in words. So we've got the Austin horizon sitting in the front. You can see that right or northerly plunge that I described. We've stylized some underground workings on here with the shaft accessing the Austin. In the background is the McVeigh, identical in terms of mineralization, and it plunges to the left or to the south. And so you can see as they're mining deeper in the Austin, they would have been missing the McVeigh horizon. So we'll look at what we describe as a long section, which is along the plane of the McVeigh on the next slide. We'll strip away the Austin, which sits in front, and you get a sense of that south plunge. So here the Austin would sit in front of us. It would plunge off to the right. The McVeigh plunges to the left. Previous mine workings are shown in gray. So on the right side, we have mining down to 230 meter depth. On the left, we're 100 meters. All of those dots that we're showing on here are drill holes that we've drilled this year, and they're color-coded by grade times thickness. And so what we're demonstrating is the south plunge, and we're demonstrating the potential for high-grade mineralization below any mining within the McVeigh horizon, and quite shallow. I will highlight on this slide on the left side, you can see the McVeigh portal and ramp decline. That portal and ramp is in place. That is what we're permitting to reopen, and we should have those approvals again in December this year. That will give us access to the underground, and it'll give access to the mineralization that we're discovering underneath the mine workings. We'll zoom in on the left side there, just to give you a flavor of some of the results that we've put out this year. You can see 11 grams per ton over 10 meters. We've got 50 grams per ton over 4 meters, just over 30 over 3.7 meters. Some pretty stunning results, well below the mine workings. We continue to step out on this mineralization, pushing it down towards depth. At the end of the day, we suspect it'll end up similar to what we see in the Austin, which historically was around 4 to 6 meters width, and historically had an average head grade of 10 grams per ton. So I will talk very briefly about the Austin. The Austin shown here, you can see that rightward plunge to it, again open to depth. As we started to drill more and more through the Austin and into the McVeigh, we started to understand better what was controlling mineralization. And you can see some very pronounced gaps on here between some of the mineralization up and down, and we could explain that geologically. And what we observed was we felt we had another gap developing here and potential for another rod of mineralization, if you will, on the south end of the Austin. So we tested that about 6 weeks ago, and our first hole into it returned 8 meters at 25 grams. Second hole was 1 meter at 17 grams. We've got a couple of historic holes on here. The deeper one, 11 dash, ran 10 meters at 18 grams. And the hole above that was about 4 meters at 40 grams. We call this the A3 target. It sits on the south side of the Austin, and again, it's another example of the opportunity that presents itself within a past operating mine environment. This, again, is right in the footprint of the proposed infrastructure with respect to our economic analysis that I'll talk to in a minute. So if we step back and look at the property package, we're also looking at kind of working from the outside in and looking for what other opportunities there may be on the broader property. We talked about the Austin and the McVeigh in the Madsen mine, sitting here right in the heart of the property. We started to map those Austin and McVeigh horizons at surface, and they're very distinguishable. And we mapped them to the south towards the Starrett-Olsen mine, which, if you recall, we also own. It operated for 8 years and last mined successfully in 1956. We could trace the Austin and McVeigh all the way to the Starrett-Olsen mine. It's about 2.5 kilometers. There's not a lot of data left from Starrett, And we did manage to recover some of the geological mapping. We saw the same features we see in the Madsen mine in terms of those controls. Look very similar to the Austin and McVeigh. So what we did is we put the first drilling in here again about 2 months ago, and our first result here shown on the right side of a long section up in here ran 11 meters at 34 grams. Pretty fantastic result. It sits about 300 meters below past mine workings in the Sterret-Olsen mine. The Sterret mine was mined much more shallowly than Madsen. It used to be held by a different operator, and they pushed it up to that company boundary. So on the bottom there, you see a long section running across from the Sterret-Olsen mine to the Madsen mine. We can see the rightward plunge on the Madsen mine. You can see the Sterret-Olsen mine. We see the same thing there with opportunities lying between Sterret and Madsen. When combined, you're looking at a 5-kilometer expression here of a high-grade gold system that's in place. We've got 2 successful mines that operated there, and the gap between Sterret and Madsen we think is ripe for an exploration discovery. It's where we're projecting the McVeigh, and it's where we're currently targeting, and we feel it'll be the heart of future mining operation at Madsen. So if we talk about that, this is a PEA that we released in April this year. And what we wanted to do was really establish kind of a base value of the property. So what this takes into account is the existing infrastructure, the existing resource, but does not take into account any of the drilling that we've conducted since we acquired the property. So this is using that in situ 1.2 million ounce resource. What we wanted to do here, our goal or objective, if you will, was to minimize upfront initial capital. So we took a little bit different approach. We said, what if we take that existing ramp that now goes down to 150 meters and drove it down to 600 meters? Let's have a look at what portion of the resource we could capture within that top 600 meters. In doing so, we were not looking at any kind of refurbishment of the shaft. We were looking at refurbishment of the underground drifts. It was new ramp development to access that resource. So what it did is it captured about a quarter of the resource. We see a mine plan here that's 6.5 years. It's 260,000 ounces. It'll produce about 50,000 ounces a year at a gold price of $11.75 US per ounce and an exchange rate of 1.25 US dollar Canadian dollar exchange rate. We pay back in 1.5 years. The initial capital is $20 million, which is extremely low. But why is that so? Well, it's because we already have a mill. We already have a tailings facility. We already have a ramp that's collared in place and down to 150 meters. So that capital is about $3 million to put the mill back into an operating state. Most of it is ramp development. Very robust IRR and NPV and fairly conservative metal prices. This is a base case, and I would call it our worst case scenario. This is if we don't discover another ounce on the property. I talked about the potential of the McVeigh. I talked about the new A3 target. I talked about intersections that we're having on the Russet South target, up dip of the 8th zone near surface, and then we step 2.5 kilometers to the Sterret-Olsen mine, and we're having success in intersecting high-grade mineralization near surface at the Sterret-Olsen mine. Any ounces that we can add through our drilling program is immediately accretive to this study. So our goal over this year and into next year is to build on that resource. We want to take it from 260,000 ounces up to beyond a 10-year mine life and more. If we add 700,000 ounces of mineable material there, we would have 1 million ounces of mineable. That would allow us to look at the mill and optimize its throughput. The mill is a 550 ton per day mill, but our permit allows for 1,089 tons per day. So we can move that from a 50,000 ounce per year producer to a 100,000 ounce per year producer with the right resource base. So what you'll see us over the next year continue to do is be aggressive. As I said, we're opening up the underground. In January, we'll be underground. We'll launch an underground exploration program. In addition, we'll continue to step out from surface to push the boundary of the McVeigh, to trace that gap between the Sterret-Olsen mine and the McVeigh horizon, and to try and identify potential resources beyond what we see from the underground. We will be looking to update the resource about mid-next year, and then we'll follow that up with revision of the PEA, or depending on the size of the resource, we move it towards pre-feasibility and feasibility. What you can see here is there's fantastic potential on this property to grow the resource. It's in the heart of a project that has existing infrastructure, that has an existing high-grade resource, that has a permit to operate the mill and tailings facility. And so we feel that we're in a very good place as we move the project forward. So with that, I'll wrap it up, and I want to thank you very much for taking the time to listen to the story of Pure Gold.
Thanks very much, Darren. Yeah, I've accumulated a little bit of time So unfortunately, won't be time for questions. Our next presentation is by, I believe, Monsieur Jean Martineau, President and CEO of Dynacor Gold Mines. Jean has over 30 years of experience in the mining industry, Canada, but the last 20 years has been in South America. There, I got that. Jean, if you just want to come up right over, and I'll keep it short. Bonjour, ça va bien?
Merci.
Le pointeur, c'est là.
C'est ça. OK, parfait.
Puis quand ce sera la vidéo, je viendrai, tu te présenter.
Oui. Pour avancer, c'est celle-là? OK, good. Well, good morning, gentlemen. Welcome to this presentation of Dynacor Gold. Well, first, the standard forward-looking statement. Well, Dynacor is a company based in Montreal, listed on the Toronto Stock Exchange, and all our operations are in Peru. So we have a unique business model in a way that we have two subsidiaries in Peru. One is an ore processing, which generates cash, and we have a subsidiary which is an exploration company developing different properties in Peru. So how it works for the ore processing, we have a mill. We had a mill of 250 tons per day. We've been in this operation for 18 years, and we just built a brand new mill of 300 tons per day. So we buy ore from hundreds of small miners registered with the government in Peru. We process it, and we sell the gold. So we have actually, we own 2 gold ore processing mills and 3 gold exploration assets in Peru. We have a tight share structure, 38.7 million shares, which we try to control very well. We have listed this company in October 2007 with 30 million shares, and actually we have 38.7. So we have generated 22 consecutive profitable quarters over the last 5 years and a half. So it has been a pretty stable and a very good operation for us there. We have been in this business for 18 years. Here we are situated in Peru. Both mills, the old mills, Metalex, is here in the southern part of Peru, about 6 hours from the main road. And we just built a brand new mill in Veta Dorada, just beside the coast, beside the road, so much more accessible. So the old mill is here. It's actually in care and maintenance, and we moved all the production in the new mill here, which we started at the end of September of this year. So because of the new mill, we expect to grow the earnings in the coming year. We'll at least double that. We had, in the last 4 quarters, 10.6 cents in Canadian dollars in net profit, and we expect to more than double that with the new operation. So if you look at that, the old mill here, we have been in operation, sorry. Okay. The old mill here has been in operation until the end of September of this year. We have been working for the first 3 quarters of this year at 210 tons per day. And we were on an annualized basis of 67,000 ounces of gold. We moved all the production to the new mill at the end of September. Now we're operating at 350 tons per day, 250 tons per day, and we expect to increase that to the maximum actual capacity of the mill at 300 tons per day in the coming months. So based on that, actually we are operating at 83,000 ounces of gold per year, but at 300 tons per day, we should process more or less 100,000 tons per year. And with the actual permit, we can increase that to 360 tons per day, which we expect to do in the next year. So at this level of production, we should process close to 120,000 ounces of gold per year. If we look at the past 5 years, here you have the net earnings, 2011 to 2015. So what's interesting here, and we'll see in a following page, in 2015 we generated $3.2 million in net profit, or 9 cents per share. And we'll see in the first 3 quarters of this year, we have already generated $3.1 million, and we just moved in the new mill where we'll increase the gross margin substantially. So if you look at this one here, you have 3 scenarios, one at $1,100 of gold price, $1,200 and $1,300. So today we are at $1,200, and you could see the gross margin, the gross operating margin, we should generate at 300 tons per day, which is the second one here. And going to 360 tons per day next year, we should be there. And actually, in the first 3 months of this year, in the first 3 quarters, we've been here, the red line here. So if the gold price comes down, it's what you have here. And if it goes up to $1,300, it's what you have on the right-hand side. So it's quite a good change with this new mill, which we just started 1 month ago. So what is the difference with this new mill? We expect a much higher gross margin than what we had up to today. Our target over the last years have been always 17% as a gross margin. And with the new mill, we expect to increase that substantially for different reasons. First of all, the old mill was not connected to the national grid, so we had to generate our own energy, which is costly. It's about 27 cents per kilowatt hour. And being connected to the national grid will be around 8 cents per kilowatt hour. Because of higher throughput, we are going to lower our fixed costs per ounces. And just on the tailing savings, for example, where we were, it was more and more difficult to build new tailing ponds, and the costs already reach almost $15 per ton. In the new place, you'll see it on a video later on. It's flat. It's very easy to do that, and the cost is less than $2 per ounce. So just with the tailing savings, we will increase our gross margin by $1.3 million a year. So that's why we expect to increase this gross margin of 17% substantially. Over the 5 years, this margin has been between 14 and 21%. But with the new mill, we expect to increase that by several percentage points. So in 2016, what happened in the company, we have obtained a $10 million credit facility in January to be sure that we have enough cash to finish the mill and have enough cash to be able to buy this ore, because buying the ore from small miners, we have to pay them right away. So it's a cash incentive business. We finished the construction of the mill in May. We have began the construction in June 2015. We finished that in May. The plant startup was September 25, so it means just less than 2 months ago. In the first 9 months of this year, we have $69.3 million in net sales. We have generated $5.4 million in cash flow and $3.1 million in net earnings. And you can compare that with last year, where we have generated $3.2 million in net profit for all the year. So this year, adding the last quarter, we should be somewhere probably between 4 and 4.5, and it gives a good look at what will happen in the next year operating the new mill on a full year basis. So actually, the market cap is 113 million Canadian dollars, means around 90 million US dollars. So the near-term investment drivers, we have a new cost-efficient mill compared to what we had until recently. We'll increase the cash flow substantially, as we just saw, and we'll increase the profit margin substantially to, in a first step, going to 300 ton per day, and later on next year, 360 ton per day. This mill has been built to process in the first step 300 ton per day, but it has been designed to be increased in the future to 600 ton per day. So we can increase that step by step. We can go to 360 ton per day with the actual permit. And to go over that, we need to apply for a new permit, which we will begin these paperwork in the coming weeks. And before the end of next year, we'll be ready to go to 450 ton per day if the market is there to feed that mill. So I'd like to go now with a short video where you'll see the new operation, the new mill. It's less than 4 minutes.
I'm running late, so I would maybe I can play during the coffee break because I'm really running late in terms of the time. So if you don't mind, if you can continue your presentation.
No problem.
Merci.
Okay. Well, okay. The other subsidiary of the company is Tumipampa. It's exploration property, and we bought that in 2000. We did already more than 2 kilometers of underground development and adits. You have here a view of the campsite there, and this is one of the adits the crosscut we have built over the years. Here, this is the claims of the property. These are the main claims we have. We have 48,000 hectares, 4,800 hectares there, and all the development of property has been done there. Recently, we bought what you see in blue here. It's another 46 hectares. This one has been freed, and we had the opportunity to buy it first, and we'll explore that later on this year. And here we bought another 300 hectares. This part is really interesting because on the property here, as we'll see, we have it disseminated here, and the structure of this property are in this direction here. So it looks like these structures are continuing here, and that's why we have acquired that. So we have extended that substantially, and if you look at the maps here, actually we're surrounded. When we came here in 2000, there was no other company. We were the first one there. And now you have Buenaventura, Southern Peru, Barrick Gold, Anglo-American, Iron Gold. It's now a very, very active exploration campsite. So here's just a view on the surface. We began the exploration here on the veins. We bought this property for 4 high-grade gold veins in the past. Today we have identified 25 of these veins. And over the years we have identified a huge skarn on the northern part of the property here, which is 4.1 kilometers long by 1.7 kilometers wide. And a year and a half ago we discovered here a large porphyry. And following that, here we have identified a very, very interesting zone, which is a disseminated zone just on the surface. We took thousands of samples on that. It's very accessible, easy to drill, fast to drill, cheap to explore. So today we have 4 different structures on that property. These high-grade gold veins, skarn, porphyry, and this disseminated. And it's because this structure here seemed to continue in the south, while we bought the 300 hectares on the southern part. So we are in exploration in this, and we pay the exploration on this with the cash generated with the mill. So in this way, we don't have to dilute the shareholders. Just to show you an example of the veins here, you have, in the main crosscut, we went through a Manto Dorado structure, and we have identified here, we have 15.5 grams of gold per ton over 7.4 meters. And in this 7.4 meters, there is a 36.5 gram per ton over 85 meters. This is not the average. The average gold grade we have in these veins is around 0.4 ounces per ton, but it's still pretty high. And we have identified up to today 25 of these veins. And here you have an overview of the property. This is the porphyry system here. The skarn is just on the north of the property. The disseminated is on the other side here, and the veins are on that side there. So we have a large property. It's a lot of work to do there, but up to today we found gold in all these structures, so it's very, very exciting there. We've been in Peru for 20 years now. We've been there since 1996. We have 325 employees in Peru, and they receive 8% of the profit before taxes. So it means that we have the possibility to retain our employees easily, and it's create a sense of pride with them. We have a very, very good team there, and it's going very well with this. We don't have a turnover of a high turnover of employees there. We have to invest in a corporate social program, like here you have a photo of a library for a local community. We have about computers for local school. We've built roads around these communities, so it maintains a good relationship with them. And in Peru, it's really, well, in most countries in the world, but especially in Peru, it's very, very important. So the capital structure, the company share outstanding 38.5 million shares. Fully diluted is 41.9. We have actually $16.1 million in working cap, $7 million in cash, and the credit facility, $10 million. We drawn on that already. We have drawn $7 million and repaid $0.7 million. So it's a very good situation. We won't need any more cash to expand the capacity to 360 ton per day next year. And well, we started the mill at the end of September. We didn't have any problem to start a mill. It went very, very easy. So now we are operating at 250 ton per day, and we're gonna ramp it up slowly to 300 ton per day. So this is what we have there. I thank you very much for your attention, and we'll be the other side for any more question if somebody is interested to learn more about Dynacore.
I owe him one. I will play the video just before the coffee break, but the coffee break was supposed to start now, but I have the honor now of presenting Robert Archer, so I will play the video, but unfortunately, because we have the live streaming, I have to cut. So it's my error, but please forgive me for that. So Robert Archer is the president, CEO, and co-founder of Great Panther Silver, company that has assets in Mexico, silver assets. So Robert, if you want to come over here on the stage. Yeah. So Robert, experience over 40 years in Aranda, Rio Algom, Placer Domen, etc. So Robert, you take it on. Okay.
Thanks, Eric. Good morning, everyone. So many of you are familiar with Great Panther. I've been coming here to present for, I think, about 12 years or so. An interesting update. It's been a very exciting year. The way metal prices have increased and improved operations and so on. So I'll just move forward to give you a bit of an update. Standard disclaimer, please do your homework. So we are a precious metals producer. About 94% of our revenue right now comes from silver and gold. A small amount of lead zinc from one of our operations. We're not hedged, no royalties, no streams of any kind. Our mines are 100% owned in Mexico. We do have some potential for production in Peru for a project that we've been working on. We actually had an option agreement on it for about a year, which we terminated that agreement in May, but continued to work on the project, and we're still trying to move forward with an acquisition on that. And if that's successful, then we could have a mine in Peru within about a year. So it's a very exciting development, and I can't say too much more about it at the moment, but hopefully we'll have some news before too long. One of the important things that we've done this year is to do a financing this summer. We were able to take advantage of run-up in metal prices and share prices, and so we had a $30 million bought deal in July. And so right now we have a very strong balance sheet with about $53 million in cash, $70 million in working capital, and no debt. We We also have a $10 million credit facility that we've not tapped into. So we're in a very good position to complete either this acquisition in Peru or other acquisition on top of that even. We've demonstrated that we can get our costs down through a disciplined approach to our existing operations, and really driven our costs well down such that even last year we were generating a small amount of positive cash flow, and now every dollar that metal prices goes up goes pretty much straight to the bottom line. So lots of growth potential, and I'll just run through a few points on that. Just on the cost perspective, you can see here on a quarterly basis how we've managed to drive our costs down. On a cash cost basis, very low, and a big part of that, to be honest, is due to foreign exchange rates, stronger dollar, weaker peso, and I have a chart on that to demonstrate how that's benefited the company. On the left, you can see the operating costs and how they're very low. On the right is the sustaining cost. The main difference between those is just mine development, drilling, expenditures on capital projects, and the reason for the rise in Q3 on the sustaining costs is the expansion of a tailings facility at our smaller mine at Topia and Durango, where we're expanding the tailings facility in order to give us another 5 to 7 years mine life there, and that's a project that started in Q3, will continue through Q4 and Q1. So we'll see the sustaining costs a little bit higher through that period while we complete that project. But going beyond that, we should get back down to normal sustaining costs at Topia. Just again, in terms of revenues and operating earnings, with the higher metal prices, that's benefited both of those, and that in itself generating good profit margins for us. This is just a look back to full year 2015, a little bit of a snapshot, just to indicate that even at that time, with average silver price just a little over $15 for all of last year, you can see our projects on the right, how we were able to keep our costs below the spot price, and so still generating some positive cash flow. So compared to some of our peers, the operations have done really well. And of course, this year with higher metal prices, we benefited from that quite a bit. As far as the financial summary, I'm not going to run through all these numbers. You can see some of the trends quarter over quarter, and revenues increasing, earnings increasing. One of the things that I would like to point out is just on the third line, the net income line. What we've done in the third quarter is started to report our financials in US dollars, and also we've changed the functional currency in Mexico from the peso to US dollars as well. And what that's done effectively is allow us to basically get rid of an obligation to report an adjustment on the foreign exchange rate each quarter, and whereas before that made it look like we had a loss rather than income, but that's really a non-cash adjustment, and so now being able to report in US dollars the numbers better reflect what's actually happening at site. So the losses before were largely paper losses, and so now we're looking at positive income going forward. So more of a perception thing than anything else, but it's important for us. And so yeah, on the costs, you can see what I've just discussed as well. Put in this chart just to really demonstrate what I was talking about with the foreign exchange rates, and you can see how the dollar has strengthened with respect to the peso over the last year, and that's been really beneficial for us because our costs are primarily in pesos and revenues in dollars. So right at the right hand side of this, you can see the sharp rise in the dollar versus the peso, and that's the Trump effect, with people people thinking that he's going to build a wall across the border with Mexico, and it's going to affect trade and so on and so forth. So that's been beneficial for us. And as for any of you that were listening to Claude's speech this morning talking about buying the dips, we do the same sort of thing on a currency basis. And so when the peso weakens, we can buy pesos in the market as well. And so that puts us in a good position to cover a good chunk of our costs going forward at better FX rates. So we try to take advantage of these dips in the currency. Just focusing in on the operations now. Our flagship operation is in central Mexico at Guanajuato. The smaller operation in Topia, northwestern Durango state. Mexico is still the #1 silver producing country in the world. And within the Guanajuato district, this is a very prolific district in Mexico, second largest silver producing district after Fresnillo, and has been producing silver for more than 400 years, more than 1 billion ounces of silver produced. And it has a terrific infrastructure that you can see here. The main operations right at in the city of Guanajuato. Just down here, it's where the plant is located. We have a satellite operation here at San Ignacio, which is actually producing about 60% of the... That wasn't me. About 60% of the production coming from San Ignacio versus the Guanajuato mine itself. But what's important here is that everything within this district is within trucking distance back to that plant. So even though we're at capacity at the plant right now, we are drilling a resource at the El Horcon project up in the top left of the slide. And once we've better defined that resource, we can then determine how much of a plant expansion we might need in order to truck the ore back around to the plant, because these are all paved highways that you see on here, so the infrastructure is excellent. It means that we can get something into production very quickly without having to go through the process of building a new plant and permitting tailings dams and so on. Just looking at the operation itself, and again, just to point out, cash costs very low, close to zero, which effectively tells you that we're generating about as much revenue on our byproduct, which is gold, in this case, as from the silver itself. So very low costs and very good grades. So it's a great operation. It includes the San Ignacio mine, as I mentioned, and the resource that we have here and the area that we're mining is shown within the blue rectangle at the top of the property. But we are drilling along strike to the southeast and on parallel veins, and we do anticipate being added to the resource base with that drilling over time, and just continuing to mine following that along strike. So currently we have about 7 to 8 years mine life defined on this project. And that should be expanding. The discovery hole was only drilled in 2010. We had this in production within 3.5 years by the middle of 2014, and we were able to do that because, as I mentioned, we didn't have to build a separate plant and so on, and we just trucked the ore around to the main plant at Guanajuato. But this is now, I say, producing about 60% of the throughput at that plant. The Topia mine in Durango normally accounts for about 25% of our production, a little bit lower in Q3 because we had a couple of temporary shutdowns there. But the grades are higher here. It's a narrow vein underground type operation, so it is a little higher cost, as you can see. But the higher grades account for that, and so it still allows us to maintain profitability there. The sustaining costs, again, higher in Q3, and they'll stay high for a couple of quarters while we complete the expansion of the tailings facility, but that'll be largely temporary. So overall, we've been growing the company year over year, pretty much since we started in 2004. This year, we're more or less flat because we're at capacity at both operations. And so we're either looking at expanding the existing operations or expanding production through an acquisition. So that's what we're very focused on that at the moment. Right now, we're tracking to about 4 million ounces, so at the lower end of guidance. And I should just caution that with the expansion of the tailings facility at Topia, there is the potential for that to cause a bit of a disruption in the production there. But again, once we complete the project, then we get back on track with that and hopefully make up for any lost ground. So looking forward, in addition to production, cash costs, we actually reduced our guidance mid-year because the costs were coming down quite a bit. And right now we're actually tracking to be below the low end of our cash cost guidance. Sustaining costs, at the moment we're below the low end, but depending on what happens in Q4 with the situation at Topia, we'll probably still come in around the low end of guidance on sustaining costs as well. In terms of capital structure, with the financing, we've got 166 million shares out right now. But what's really important is the liquidity that the company has, trading on 2 stock exchanges in Toronto and New York. We typically trade anywhere from 5 to 1 to 10 to 1 in terms of volume on New York. Overall, trading about 2 million shares a day, so excellent liquidity. And as I mentioned, with the cash position, or with the financing rather, that we did this summer, we have a very strong cash position. So I thought I'd stick a slide in here because it's been such an interesting year for metal prices and share prices, just to kind of walk you through a little bit about what we think has happened with our share price in particular, and why we've seen the kind of volatility that we've had. So a year ago, everybody was complaining about the low share prices. Everything was oversold. We've gone through a long period of consolidation. And then in January, gold and silver prices started to rise. We thought, great, finally, it's been a long 5 years, a lot of people smiling. And then they continued to build. We thought, great, this is going to continue. A lot of new retail shareholders coming in, built up a lot of momentum. Stock prices are going up even higher. And then in the U.S., they have this phenomenon we call pump and dump artists. These guys that like to promote stocks. They buy in at a low level, promote them, and then sell them off at the top. So that's basically what was happening at the peak here. They were driving the share price up, and then at the peak of that, around April 30th, the flip side of that coin is the short sellers who do the exact opposite, and they short the stock and then come out with a report that basically tells people not to buy the stock, and so that pushes the share price back down. They cover their short position, they make a lot of money. And so you see these kinds of sharp peaks. That's pretty much what's going on at that time. So it really has nothing to do with the company, nothing to do with fundamentals. It's really just a form of market manipulation. So after that, went through another little period of consolidation, and then silver price rose back up to a little over $20. Share price came back up. We were able to finance right at the peak there, and so it was a very good price for us. Put $30 million in the till, and the silver price came back down after that, and so we're sitting now a little under $17, and so the stock price is pretty much consolidated at these levels now. So just waiting for the next run up in silver prices, because what we see is that we have tremendous leverage to the silver price. This is a 10-year chart, and you can see what happened in the last run up in 2011, how well the share price responded to the rise in silver price at that time. And then even just this year, as I mentioned, as soon as the silver price started to come back up again, the stock price performed really well. So we have tremendous leverage to the silver price, and we foresee that continuing into the future. So in summary, we think one reason you should be looking at, or several reasons you should be looking at Great Panther. We are a low-cost producer, excellent leverage to the silver price. We've demonstrated that we can successfully grow our production while keeping our costs down. We have a very strong balance sheet at the moment with no debt, and using that to look for acquisitions. And if we're successful with that, whether it's the one we're working on right now or something else or both, we should see a fairly significant re-rating in the stock at that time. And always easy to trade, especially in New York, because of our great liquidity. So with that, I'll wrap up, and back to you, Eric.
Okay, well, thank you very much, Albert. Thank you. So it's the coffee break, ladies and gentlemen. I'll put the Tumapampa video of Dynacor Mines for those who are...
Dynacor Gold Mines is a Canadian company that produces gold and explores its mining concessions in Peru. It began operations in 1996 through its wholly owned Peruvian subsidiaries. Part of its gold production cash flows are used to finance its exploration campaigns at its flagship gold project, Tumapampa. Minera Veta Dorada employs more than 300 people working from its headquarters in Lima, at its gold production facilities, and at its 6 ore purchasing regional offices, including the main one located in Nazca. Ore processing is a capital-intensive business in which Minera Veta Dorada purchases and processes on a daily basis ore supplied by more than 200 artisanal small miners from throughout Peru. The ore was trucked to the Metalex plant on a narrow winding road leading to the ore processing facility located many hours off the Pan American Highway near a remote village of Huanca. Suppliers have faithfully used that road for more than 18 years, building with Minera Veta Dorada a solid business relationship based on trust and respect. The Metalex plant has proven over time to be a steady operator and gold producer. Acquired in 1996 as a partially built 50-ton-per-day mill, it poured its first gold bar in 1998. Since then, its production capacity has grown organically through a methodical and disciplined approach, reaching a nearly average of 65,000 ounces of gold over the last 5 years. Working only with government-registered miners, Dynacor has become de facto a natural partner of the Peruvian authorities in their efforts to formalize the small-scale mining sector. It is the best eco-responsible solution for the processing of ore produced by small artisanal miners, helping to reduce and hopefully eliminate the use of mercury, which is often part of the artisanal gold recovery process. Furthermore, the plant complies with all the Peruvian mining regulations, has an efficient and eco-responsible water recycling system, and secure tailing ponds. Years ago, Jean Martineau, president and CEO of Dynacor Gold Mines, outlined his plan to launch Dynacor to become a leader in the Peruvian ore processing industry. This could, however, only be achieved by expanding and relocating the company's gold-producing facility. The process began in 2011 with the filing of an environmental impact study for the construction of a brand new milling facility in southern Peru. This 5-year project was implemented by Dynacor's Peruvian management team at Minera Veta Dorada. In September 2016, this long-term goal became reality when the company obtained the operating permit for its new Veta Dorada ore processing plant. The new plant is strategically located just miles off the Pan American Highway in Chala, Peru. Its 95-hectare concession, efficient design layout, and centralized location provide opportunity for future mill expansions. together with decades of safe, inexpensive tailing storage, it is a game changer for both the company and the small-scale mining industry in Peru. After 18 years of successful operation of the MetalX plant, it is now time to turn to a more modern, effective, and cost-efficient operation that has been designed to allow future increases in milling capacity in the near future in step with ore supply. Built to drive the Peruvian ore processing industry to new heights, the opening of the Veta Dorada ore processing plant is truly welcome. Welcome to the new Veta Dorada plant.
think I'm going to start. Is the sound good? Perfect. So I have the honor of introducing our next speaker, our keynote speaker, Mr. Eric Meyer, CEO and partner at Conwave AG. Eric has been a partner there since April 2012. He is a member of the CFA Institute and holds a Swiss banking diploma. He's got many years in the banking industry, has great insight on the mineral industry, and particularly in gold. His talk will be flash in the pan or a great buying opportunity. Always a pleasure to have Eric as a conference keynote speaker. So Eric, you've got the stage, and give us some great insight.
Thank you.
You're
Eric.
welcome. We start over here. Steve.
Okay. Bonjour à tout le monde. Good morning, everyone. Happy to be here again. Last two times I was here, we were not yet in a bull market, so it's good to be back in a bull market. But obviously, as we were going through some difficult years from 2011 to 15, obviously one still has to question: was that the bottom, or will we see another ugly bear market soon? That's the disclaimer, which for time reason we skip rather fast. That's the agenda. I'm talking about gold, why gold equities, and very shortly why our fund. The gold side is driven mainly by investment demand. I mean, jewelry is important, the supply is important, we see supply coming back in the next few years, but at the end of the day, investment demand has always been the key driver of the gold price. And something we are addressing today is something we feel the market is very sleepy about it. It doesn't recognize the problem yet, but this is the key reason why gold, and why even the recent correction, is something which we consider as a buying opportunity and not something to get nervous about. The key reason for gold for the next few years to rise massively is the unsustainable situation which is being shown in a kind of trust. We are heading into a confidence crisis as we've been heading into the 70s or into 2011. People are losing confidence in the system, in the government, in the central banks, which are cornered now by the markets, into the banking system, and finally, in a few years, into the currencies. And this is why gold will move much higher than where we are today. And this confidence crisis, you see it very easily if you look at election results, regional elections in Italy, in France, in Germany, in Austria, Brexit decision, and Donald Trump. It shows we are heading into a new confidence crisis, and this was always the biggest driver behind gold bull markets. The situation of getting the lowest yield since 5,000 years, combined with the worst debt situation ever, just doesn't make any sense. Why should one get the lowest risk premium for the highest risk? Only stupid guys buy that. Our central banks buy it. The insurance companies have to buy it. So there are buyers around. Now, coming back to maybe what people are nervous these days, especially after Trump, the dollar, Fed fund cycle, real rates. We clearly said in the last two conferences the lights are turning from red into green. We are now back in green. This dollar strength is a joke, is unsustainable, if you ask me, unless we get a major crisis in Europe. Donald Trump wants a lower dollar. The US is not competitive. 5 years ago, the trade deficit was over 600 billion, and everyone was expecting that to shrink a lot, given that over 40% of the trade deficit was oil-related. Today, it's still sitting above 600 billion per year, and there is not a lot of oil anymore being imported. So the structural trade deficit is going up consistently, And this is the reason why the dollar since Bretton Woods is a weak currency. If you look at the strong currencies since 1970, it's the Swiss franc, Japanese yen, and German mark. 3 countries with the lowest growth, the lowest yields, the lowest interest rates, but current account surpluses, which come, with the exception of Switzerland, from the trade side. And this is why the dollar is in the long run a very weak currency. Donald Trump can't change the problem we have globally in the industrialized nations, which are over-indebtedness and demographic issue, i.e. we are all getting too old. Gray hair is rising, it's coming up every year. So this is the reason why we are not nervous and consider the recent situation as a great buying opportunity. The Fed fund cycle is the same joke. People feel Donald Trump wants to be aggressive on hiking rates. If he would implement that through the Fed, which is anyway a bit difficult, but many things are possible in the US, it would lead to a higher dollar, contrary to what Donald Trump wants. If you look at Japan, and don't forget, what we see now in Europe and in the US is the same what Japan exhibited from 1990 to 2010. It's a so-called balance sheet recession. Too much debt and too much old people doesn't work. Japan tried it with infrastructure programs many times. It always leads to a short bump in economic growth, maybe even a short rise in yields like we have seen recently, but not sustainable. This does not fix the problem. We need a reset, but no political guy wants a reset because he won't be elected after the reset. So real rates, again, have been rising 10 basis points. It's no joke. I just read it this morning in the train, and people are nervous about that. And don't forget, Japan and the US are competing on the monetary side. If you look at central bank policy, sometimes the US introduces an action, a few months later Japan. Now Japan went out, the BOJ, with a very important signal which the market is sleeping about, and they said, we will fix the long-term yields. We will not allow long-term yields to rise. And for good reasons, because it would kill Japan, but it would also kill Europe and the US. So don't be surprised if the Fed comes out in a few days, for a few weeks, or maybe a few months, and tells the world, don't fight against us. We will buy unlimited on the long end to keep the curve down. Because this is called financial repression, and the Fed hopes without war or without social unrest to get out of the crisis. I'm not sure if it will work, but at least they will try it as Japan does it. And you can be sure the Fed doesn't even need to buy bonds, because the day they make the announcement, no one will hesitate to battle against the most powerful central bank in the world. So they don't even need to buy it. And don't forget, the Fed did it already in the 90s, 50s, for many years. The long-term yields were fixed by the Fed, and the market accepted it. So with inflation coming up in the mid to long term, thanks to these programs, some inflation will come up at the same time. The long-term yields will stay very low, so real rates go more negative again, and this will be also a driver behind gold. But don't forget, the big thing is the confidence thing. People are losing confidence. It started with government. It's going on now with central banks. We'll see it in the government bond markets and finally in the currencies. This is an interesting observation from Ned Davis showing since 1926 to 2015, when should you add gold to a balanced portfolio. There are exactly 3 environments, and we are not gold bugs. We founded the fund in 1999, and we will close it in a few years when the cycle is over. But this comes from an independent resource, Ned Davis, quality research, about 10 times better than what you get from any bank or any broker. You need to have gold in a balanced portfolio if and when the US stock market is expensive. Today we are trading on trailing P 60% above long-term averages, on Schiller P 80% above long-term average. If you look at price book, price sales, we have the highest valuation ever. Markets are expensive. Then more interesting, the one to the right, gold does very well when the Fed was hiking rates in the past, contrary to what all these brokers and banks are trying to tell you. Don't forget, banks have no interest in recommending gold. It's the worst asset from them. It's the smallest margin, and in the worst case, the client even takes the physical away, so they lose even the assets under management. I've been working for banks, and this is why Swiss banks recommended gold the first time in 2011. It was a good timing. I sold my gold then. So Fed hiking cycle is not a problem for gold because the Fed is always, with one exception, Paul Volcker 1980, behind the inflation curve. And the market will come back to this correlation. We don't know when, but the unrealistic thing, what's happening right now in the last few weeks with higher rates, it's very normal. You know, today there are so many big hedge funds and even asset managers just have models. Long yields go up, go long dollar, short yen, short gold, long Nikkei, etc. No chance for human beings to act as quickly as these computers do, but doesn't mean the computers will be right. Number 3 was, by the way, when long-term rates go up. So actually exactly the environment we have today. As a summary on gold, I think I need to speed up a little bit. Just 2 things. The gold ETF, which were sold from investors between 2013 to 2015, went from so-called weak hands, short-term oriented investors in Europe and the US, into very strong hands into Asia, and the negative interest rates environment opens the door for new investors for gold. Where they said for the last 15 years, as long as I get my 1-2% risk-free, I'm not interested in gold, they are changing their view now. Now moving to the miners. It's really getting interesting because we are at the start of a new bull market, and what's very important, this is really the phase where you have to be in gold miners. November 2000 to end of 2003, massive outperformance against physical. In this phase, gold stocks do 5 to 15 times what physical does. Afterwards, the bull market, very bad for gold stocks, mismanagement, higher costs, etc. No real leverage anymore. But we are again now, since a few months, in this phase. The good thing is here, as here, companies have operating leverage, have financial leverage, management teams are disciplined, costs are under control, and gold stocks start discounting higher future gold prices. This is why in this phase you really have to be in the minus and not in physical. If you went through the bear market with physical, I told many clients or many prospective clients in the last 24 months, you need one move and all the loss which you made on physical is gone by the gains in the gold miners, which happened this year already. But this is just a start. From the November 2000 low to end of 2002, just this very first phase, gold went up 20%, gold miners went up 340%. We could be in a similar situation. Valuation, very quickly, the sector is at its lowest levels in 30 years based on price cash flow. Price book, this was before Trump, so it's actually even lower. It's around 1 times book value now. The last big bull market in 2000, November, started at 1.1 book value, went to 4.7, and gold stocks continued to rise for 2 years, but the ratio came down because over the cycle book value grows within the companies as well. So very, very cheap, very, very attractive. When do you buy gold miners? You buy miners when the commodity sector makes no money or when the margins are at the bottom. This is since 1990. This is the relative performance of gold miners between S&P. And as you can see, you always buy the miners when the commodity sector's margins are at the bottom. They recently were at the lowest level since 1950. And as a result, you see outperformance starts. What's important, the first part of the cycle is always much bigger outperformance than later on. But it's a great addition to a balanced portfolio, a few percentages gold miners. This is the dark side of this industry. It's a crazy industry. In 77 years, the industry lost 7 times between 67 to 84.5%. The good thing is, even if we didn't like it, the last bear market was the worst ever with 84.5%, and it was the second longest. Very close to the bear market in 96 to 2000. However, once you pass that, it becomes interesting, especially if you can buy like recently after a big sell-off, which we have seen. But gold stocks are volatile. We all know that. And it's a long way to go. Where could we go? This is our product performance since the bottom, about 120%. In the last cycle, we made 1,450% for our investors. That's in US dollar. Similarities, before we had a 4.75 year bear market, a decline of 84%. Now we had a 4.1/3 year bear market, 84.5%. Even in this mini cycle, which wasn't really an industry cycle, after a 7 months decline of 71%, the product made 500%. That's here the sister product actually, because the fund was only launched in 2003, the UCITS fund, while our Cayman fund is in place since 1999. So where do we go? What's our suggestion? We believe at least 1,000% is the target from the bottom, which is about 500 from today, in the next 3 to 4 years. It's not a forecast, but it's our clear view on the sector. Now, when to buy this sector? Because it's bloody volatile, and it's annoying if you lose 37% like recently from the top early August. But we look back into the bull markets. Number one bull market 2000 to 2007, then the second bull market October 08 to 2011. So it's very normal to lose between 25 to 35%. That was the worst correction, but it makes sense because the rise before was 182%, which was also the biggest rise anyway. From a Fibonacci retracement point of view, for technical guys, we had a very nice 62.8% Fibonacci retracement, which is, by the way, what happened in most of the cases. So very nice buying opportunity. We are 80 to 90% convinced that was the bottom, or we see the bottom in the next few days, and then we get the next probably 100% plus. So great time to buy. Now you can buy companies, you can also buy a fund. The fund provides you probably much lower risk as we are well diversified, but if you buy the right fund, you actually have probably even more leverage than with most companies, especially the larger cap names. Now, this is our track record. We are bull market manager. We outperform our peer group massively in bull markets. We are very slightly worse in bear markets. But if you are bullish like we are, it's a perfect product. As you can see here, our active and passive peer, the BlackRocks, the Fenix, the Tocqueville's, and the GDX, etc., we do around 1.5 times. Actually, in this bull market, we did 1.65 times. So it really pays off to go with an active managed fund, as these passive products are quite a nightmare. In bear markets, you see around 1 times the performance of the peer group. So coming to the summary, or maybe just one little word, how do we do that? We have a very nice size. We have about 400 million, which makes things quite easy. So we can speak to the companies, we can offer them deals. We currently offer, again, money to many companies. We get private placements with nice warrants which help the performance on the way up. Then another thing, we are owner of the firm. We put a lot or nearly everything of our own money into the products, so our interests are aligned with our investors' interest. Then we play the cycle of the industry more actively than our peers. So we have been preparing, as I've been telling you already 1 or 2 years ago, we have been preparing the fund for the next bull run, while our competition went very defensive in the last 2 years. They got scared like most investors. We got very interested and got very attractive, very offensive, I would say. So we increased the numbers of the smaller cap names. We have on average also 5 to 15% more small caps than our peers. But it's not a small cap fund. If someone wants to buy a small cap fund, we also have a small cap fund which is even more attractive from a return risk perspective than this one, but it's not for retailers. Actually, it's qualified investors only, as it is a Cayman fund. So this is how we do it. And as a summary, I don't want to repeat myself. I'm probably already slightly 1-2 minutes above budget. So thanks for your interest. I'm around here in case you have more questions.
Thank you very much. Trish, will you be taking the cat? Say what? I think it's side. So I have the honor of presenting our next presentator, Mr. Richard Young, President and CEO of Durango Gold Corp. So Richard is a chartered professional accountant, graduated from the University of Western Ontario with a degree in economics, and also did a graduate studies at McGill University. Has numerous years of experience in the mining industry, worked for Barrick, and has been the CEO of Durango Gold since 6 years. Richard?
Eric, thank you very much. And boy, it's a real pleasure to follow Eric. That was an excellent presentation on gold, and now we'll just tell you where we think we fit in. And so when you look at the global gold industry, I'll start off with the macro trends and then talk about why we think that Africa, in particular West Africa, is the place to be, and hopefully give you a reason to go out and buy our stock when I finish today. So in terms of looking at the global gold industry, it's been a challenge, as you can see from Eric's presentation beforehand. Because of the gold cycle, we've seen discoveries fall, we've seen grades decline, and as a result, we've now moved into a period where we're ex-growth as an industry. As one senior gold company likes to say, flat is the new growth. So the next slide just points out that we can't really turn this around quickly. It takes more than a decade from discovery until first pour for most mines. And the next slide just highlights that. So we hit peak discovery in 1995, and it was a full 20 years thereafter before we hit peak production. So a full 20 years. So the next slide actually focuses really on exploration spending and discoveries. And it doesn't really tell a good tale. So despite the fact that we have spent more money on exploration than ever before, we're generating fewer discoveries. And I think there's a couple reasons for that. First is, unlike the oil and gas sector, we haven't really made any technological changes in the way we explore. And second, a lot of those exploration dollars were spent in more mature areas where the hit rate, unfortunately, is lower. So as a result of that, we're seeing grades decline. So over the past 20 years, the average grade processed for an open pit deposit has declined by 50%. Yet as you saw in the earlier slide, production continued to increase through 2015. Well, the reason for that is that, we just moved and processed more material. And that costs money. So when you look at the industry and you look at the increase in capital costs over the last 10 years in operating costs, it's because of lower grades. We're just moving and processing much more material than we used to be able to meet that increased production. And so when you look at the senior gold producers, they look for those elephant deposits, those really big ones. But as you can see on the slide, there are very few of those. The majority of gold deposits are sub 4 million ounces. And that's really where we're focused. We believe that we're in the sweet spot of the market, the junior and mid-cap producers, where you're targeting those types of deposits that are sub 4 million ounces. Now, there are benefits to those. One is they cost less to develop. And two, generally speaking, there's lower development and operating risk attached to those. And we think that as we move forward, we're more likely to make those types of discoveries. But we've talked about the global mining space, but all's not lost. There are some areas of the world that are actually just beginning to shine. And we believe that Africa, in particular West Africa, is one of those. So when you look at the global mine production slide, Africa sat number 2 last year in the world. West Africa actually comprised half of that production profile. So if you think back, in 1990 there was virtually no gold production in West Africa. Today, it's half of African production, and it's almost equivalent to North America. We could have never imagined that 10 or 20 years ago. Clearly, Africa, in particular West Africa, is a growth area. Looking at this slide, 3 of the top 5 gold-producing regions are in Africa. When you look at West Africa, gold production has grown at 8.5% compounded annually since 1990. That far exceeds what the growth in either South Africa, North and South America, Oceania, or even Asia. So we think that Africa, in particular, West Africa, is really the place to be. And while for the most part, West Africa has been dominated by junior and mid-cap producers, we think ultimately the larger cap producers are going to have to come because it is clearly a growth area for gold discoveries. So needless to say, we think that we're in the right place at the right time. We have just expanded beyond Senegal into French West Africa, moving into Côte d'Ivoire with the exploration JV that we signed back in June. And then last month, we completed the acquisition of Griffin Minerals that took us into Burkina. We're clearly a West African growth company now. We think that we tick all the boxes when investors look for gold investment. We're located in mining-friendly jurisdictions on prospective gold belts, and as you could see from the slide earlier, we're making more discoveries here in West Africa than most other regions of the world. We've got a large, long-life asset with a reserve base of 2.6 million ounces. We've got organic growth. We have a project that generates free cash flow combined with a strong balance sheet really gives us the financial ability to move forward on these growth initiatives. And we're supported by a cornerstone investor who is the largest employer, and I'll talk a little bit more about him in a minute, that understands this region better than most. So really, as we look at the assets that we've got in our portfolio, start off with Sabodala. We've produced over 1 million ounces from Sabodala since the IPO in 2010. It's one of the most mining-friendly jurisdictions in West Africa. We straddle, this is a greenstone belt that straddles the border between Senegal and Mali. 2/3 of the belt are located in Senegal. This greenstone belt is similar to the greenstone belts you see in northern Ontario and Quebec, as well as West Australia, that have been so prolific over the past 100 years. So more than 50 million ounces have been discovered on this greenstone belt, the majority in Mali over the last 25 years. Senegal was late to the game in terms of modernizing its mining code, but more than 12 million ounces have been discovered, the majority by ourselves, as well as Rand Gold and IM Gold, who both have advanced projects in the country. So as you look at our project closer up, we start off with 1.5 million ounces at the IPO. We currently have 2.6 million ounces in reserves. So through exploration and acquisition, we've increased our reserve base net of production by 80%. We have 300 square kilometers of permitted mine license. We've moved from a single pit operation to a multiple pit operation, feeding a central mill. Our exploration program is really twofold. We've got over 4 million ounces in measured and indicated resources, so we're working to convert those open pit and underground resources to reserves. As well, we're looking for the next major discovery. We announced last month that we had made 3 discoveries, 2 on the mine license and 1 on the regional land package. They're small at this point. This is early days, but we've got 5 drill rigs drilling those, as well as a number of other targets, both on the mine license and regionally, in the coming quarters. So as we look at the year so far to date, we've had a very strong year. We've got record production through the first 3 quarters. We're on track to meet our guidance for the year. Our cost profiles come down materially, so we're generating our profits and cash flows are up. We've put $15 million on the balance sheet so far this year, and we're having a very solid year. So as we look at our life of mine plan that we announced earlier this year, we expect to be able to produce at least 200,000 ounces through 2024, and with the exploration program, we believe that we can extend that out further. And as you look at this next slide, you see that not only are we producing gold, we're generating cash flow. So at $1,200 gold, over $500 million will generate just based on our current 2P reserves of 2.6 million ounces. The cash margin on those ounces is $240 an ounce at $1,200 gold. That is after the Franco stream. That includes all corporate costs. The only costs that aren't included are income taxes, minority dividends, and interest, which is de minimis because we don't have much debt. So we think we're in a very strong position to be able to grow our business on the back of our Sabodala asset. So turning our attention to Burkina Faso, where we've just completed the acquisition of Griffin last month. And we've acquired 3 assets. Banfora, which is an advanced development project, as well as 2 earlier stage exploration projects, which are located on what we think are prolific belts. So we'll have more to say about that in a minute. So first looking at Banfora. So our timeline for Banfora is moving that into production as early as the first half of 2019. We're currently updating the feasibility study, and there's 2 elements to that. The first is updating the reserves and resources, which is well underway. The drill program that we conducted in the 3rd quarter is proving out our theory in terms of the grades and the ability to expand the original 4 deposits, which were included in Griffin's 2013 feasibility study. But beyond that, there are 11 deposits where various work has been done which are not included in reserves. And that program, exploration program, is starting this week. So as we move forward, we expect reserves to increase, and we expect to be able to bring the cost to build the project and operate the project down. It is early days, but based on the met work that we've been doing, we actually think the met work is very similar to our Sabodala mine, so we may actually build the Sabodala plant over in Burkina Faso. And that, for us, creates a number of synergies. First of all, it lowers our development risk because we know it works. Second, it lowers our capital and operating costs as we move forward. So we think that Griffin and this Banfora project is really a company maker for us. Turning our attention beyond Banfora, and what a lot of people don't talk about is the other 2 exploration properties that we acquired. Golden Hill is something that we're really excited about. it's got the right address. It is located on the Hundu Belt. It's along strike of the recently completed Rocks Gold project in Burkina Faso, a high-grade 15-gram underground deposit. It's along trend with the Siao deposit, part of the Samifo deposits, as well as close to the Mana project, which is part of Samifo, and within 15 kilometers of Hundu, which Endeavour is just starting construction now. So assuming that we move forward and start construction of Banfora, there will be 3 gold projects in development in Burkina as we speak. So we're excited by Golden Hill. There's 10 targets to be drilled, and that program is just starting this week. Elsewhere, Gorma, earlier stage, it's in the east of the country. Not a lot of work had been done prior to 2010. But what Griffin had done is they had secured about 60 kilometers of this green shear system that you see on the slide. Work's going to start on that one in 2017, and it's going to be a busy year for us, so we should have a lot of exploration results, and knock on wood, they're going to be good. So turning our attention to Côte d'Ivoire. Côte d'Ivoire is probably the #1 jurisdiction in Africa from an exploration standpoint. It's very early days, very untapped exploration potential. And we've entered with a JV with an individual, David Mimran, and the Mimran family, who are actually based here in Geneva. The Mimran family have been active in West Africa for more than half a century. They're the largest employer in both Senegal and Côte d'Ivoire, and they are looking at opportunities in Burkina Faso. And so with David and his family, we've got a local partner. And their relationships and in-depth knowledge are irreplaceable. David's also our largest shareholder with 18% of the company, and he sits on our board. This is early stages. We've got 4 exploration properties that comprise 1,400 square kilometers. We are going to continue to pick up property and move these forward. But we're very excited to be in Côte d'Ivoire, and we hope to have some great results as we move forward. So if you look at Teranga, we proved when gold prices were $1,100 and looking like they were going down that we could survive. And we've now proven, and you can see, that we can grow and put cash on the balance sheet at these prices. I think that makes us a very compelling investment opportunity. So as you look at our company over the last 5 years, we've demonstrated that we can make acquisitions and fill a portfolio. We can develop projects and build mines. And as we move forward, we'll be taking those skills forward. And we think that we are uniquely positioned in West Africa to take our production base from 200,000, which it is today. Banfora could add 100 to 150,000 ounces per year. And with this pipeline of projects, we have opportunities to, #1, extend our mine licenses, our mine lives at these 2 projects, as well as possibly create new discoveries that will lead to new mines being built. So we have a very strong portfolio as we move forward, and we believe that we're going to be able to grow both reserves and production. So despite the fact that we are a compelling investment opportunity, we are trading at a discount to our peer group. I think that the fact that we missed our production guidance last year, as well as people not understanding the Griffin transaction, are responsible for this. But as we deliver on our quarterly results, and as we mentioned earlier, we're well on track to meet our guidance for the year. We've got a number of exploration programs underway, and we expect to have encouraging results. We think that'll be a catalyst. Combined with, by the end of the second quarter next year, we expect to have an updated feasibility study on Banfora, which we believe will be positive, and then ultimately move that into production in Q3 with major construction Q4. Will all be catalysts, as well as Eric mentioned. We think gold prices ultimately are going to go up. And we think with the rising production profile that we've got, with the clean balance sheet, we're well positioned to be able to deliver strong returns for our shareholders. So we're very excited to be in West Africa, and we think we've got a great path forward. So with that, Eric, I'll open up to questions.
Thank you very much. Maybe one quick question from the audience, if there is any. I'll just try to do the transfer.
Okay.
Keep an eye on if there's any questions there.
I don't think there's any questions.
No questions, ladies and gentlemen?
So thank you very much.
I guess that's the buzz call. Hey,
Well, that was
okay.
time was good.
Yep. Thank you, Trish. I'm going to talk loud. I've got the pleasure of presenting our next conference. And I asked this morning that they be knowledgeable that there was noise like that, and obviously it didn't go through, so I'm sorry about that. I've got the honor of presenting David Oram, Executive VP of Sandstorm Gold. He is a geologist, trained geologist. He was one of the co-founders of the company, previously with Silver Wheaton. And while you come on stage, I'm going to go and see what's going on, and hopefully this won't last too long.
Thanks very much. Okay, thank you all very much. I'll try to speak up as much as I can, and hopefully we can get the sound away. Anyhow, we're Sandstorm Gold. We are a royalty and streaming company, and we represent, I think, a different type of investment. I think we're unique amongst the companies that are presenting here today at the conference. We represent something that I think applies a better risk-adjusted reward for the gold industry and for the mining industry as a whole. The company itself was started in 2009 by myself and Nolan Watson. Like Eric said, for us, we originally came from Silver Wheaton. And Silver Wheaton is a company based out of Vancouver that really originated the whole streaming model in the industry. In 2009, we began Sandstorm. Nolan has more of a finance background. He is a CFA and a chartered accountant. And he's won all sorts of different awards. He's also part of the Young Global Leaders Group as well. I'm a geologist. We also have on the top here a couple of our other finance people and corporate development people. But I think what's important to note is that bottom line of our technical team, which I think a key item in terms of the type of investments that Sandstorm makes to create its company, is to make sure you're investing in the adequate and the proper risk-adjusted investments in the industry. So you need to have a very complete and a very thorough due diligence team. So some of these gentlemen here, the first two there, Tom Brewington and Keith Laskowski, they've been with us now for about 3 years. Prior to that, they were the due diligence team for the IFC and the World Bank based out of Washington, D.C., making their investments in the industry. If you don't know, streaming and a royalty company, just very briefly, is what we do is we give upfront payments in exchange for a percentage of the future revenue or the product that's produced at the assets. What that essentially means is that once you make your investments, you're not beholden to any of the further capital that needs to go into the asset. And essentially what you do is you take a top line of the revenue, which makes and creates for you something that gives the investor or your underlying investor a much clearer viewpoint as to where the free cash flow lies in the company. Here's a few facts about Sandstorm as a company. We have 133 streams and royalties. Of those 133 assets, 21 of them are cash flowing today. We hold no debt. In fact, we have a cash balance today. And by 2019, we will be producing a gold equivalent of about 65,000 ounces. And our overall cost, our total cost for those ounces is approximately $250 per ounce. And so the difference between the commodity price at that time and the 250 is essentially the operating cash flow after tax that comes towards us. This is illustrating the distribution of our royalties around the world. As you can see with those numbers in the top right-hand corner, the bulk of our revenue comes from North America, South America, with actually Canada being the primary area that we receive our cash flow from today. Now that we're a relatively well geographically diverse company, we feel that we are in that position, though, that our cash flow is strong enough and diversified enough that we can start taking a look at jurisdictions that potentially have higher political risk associated with them, as long as we can get an asset that has a lower technical risk associated. So we do find ourselves in that position to be able to take a little bit further risks with a small portion of our capital going forward. This, to me, is a very important slide, and something that a lot of people don't realize how Sandstorm has changed over the years. This is our operating cash flow after tax. Each one of these columns represents our estimated cash flow for the subsequent years going out to 2021. There's a lot of things I want to talk about, but the first point I want to make is that this entire growth profile that you see here, the growth from about $45 million in cash flow today up to the $68 million of cash flow in 2021, we don't need to put in any further capital, any kind of investment, any of these assets to realize that growth. These are already projects and mines that are built and constructed as well. We don't require any of these assets to be built to receive this cash flow. So we are really very unique amongst the mining industry to be able to realize a significant cash flow growth without any other capital outlay going out the door, which means if this projected cash flow is achieved, that's something that goes directly back into the company and can be and gets right back into the pockets of the shareholders. What's also important to note about this cash flow is each one of these columns is broken down into those individual lines. Those individual lines represent different royalties or streams that are cash flowing. All of those assets that are in there have survived a $1,050 gold price. So we do have a good, strong base of cash flowing assets, which provides further security to our investors and to us as an investment. Now, drawing your attention to the pie chart that's in the middle of the screen, what we're trying to illustrate there is we're trying to illustrate the blend of commodities. Today, we have 85% of our revenue coming from either precious metals or diamonds. The one royalty that we have from diamonds is from the Diavik mine operated by Rio Tinto in the Northwest Territories. But of that 75%, other than that, the blend is mostly in gold. For us, we do see ourselves as a precious metals company. All the acquisitions that we see from this point onwards, we see as precious metals acquisitions. We have received some base metals in the past, but really as a byproduct to complete some transactions which are focused really on those precious metals. This next slide is a little bit of a continuation of the previous one. What we're trying to articulate in this one is that not only do we have a good solid cash flow base, but we still are able to capture that critical optionality that is very important to illustrate to shareholders in the industry. What we've done is we've taken that last column from the previous chart for 2021 cash flow of $68 million. That represents our current assets that are producing and what's coming online in our growth profile. What we wanted to illustrate with this is that assuming a higher commodity price by 2021, assuming $1,600 gold instead of $1,300, $23 silver instead of $18, and a $3 copper instead of $2.10, you would realize in that first, let me see if this works. Oops, sorry, that didn't work. You would realize in that first gray column, the 19 million, that's the additional higher cash flow that we would receive. So on top of the 68, we would receive 19 million more in additional cash flow just on those existing assets. That second gray bar, What that represents is it represents the optionality that we have. So existing royalties, existing streams that we have, in a higher gold price, we pick 4 of those that are really ready for entering that construction period but are waiting for higher commodity prices. If those 4 royalties and streams came into place and those assets were built by 2021, that's the additional cash flow that you would see fall into that profile. And that's without any additional investment from us. So seeing a rising commodity price environment, you would see our cash flow go from that $68 million to something that's closer to $108 million, which is a substantial jump, especially considering, again, no further investments would need to be made by us. And when you take us and you compare us to the other royalty and streaming companies that exist, none of the other companies have that type of profile. In fact, none of the other royalty and streaming companies have this type of growth profile without seeing construction of a bunch of assets already in their profile. So we're really unique amongst our peers. Another thing I think that's important to point out is how we've transformed ourselves over the years. I think when Sandstorm emerged, we were considered the streaming company of the junior mining industry. We had a lot of transactions with junior companies, but that's changed, especially over the last 3 years. In 2013, we saw 88% of our revenue coming from junior companies. Today, we've improved our counterparty risk by a number of ways, and now we're seeing close to 80% of our revenue coming from either mid-caps or senior companies. By 2019, we expect that to go up to close to 90%. Now, the reason that's happened is because we have been actively deploying capital with a lower counterparty risk. But what's also happened is that we've made those good investment decisions earlier on in the genesis of the company. And many of those investments that we've made have been swept up and brought in to larger companies. And now we have a base of companies that are producing for us, like Glencore, like Newmont, like Yamana, as opposed to the Brigus Golds and the Lunas of the past for us. So our cash flow is important, and understanding that good, strong cash flow base has been important for us to establish and to grow the company as. But I think what's important to know for us is the unrecognized value and the optionality in this industry that we're exposed to, that I think a lot of the market still does not understand yet. The interesting thing about this industry is that at points like what we've seen in the last 2 to 3 years, the market and investors refuse to give any kind of value to optionality. But at other parts, as you get into a rising price environment and as you get to the top environment, optionality is given almost unlimited value by the market. And so what I'm going to try to do in these next several slides is illustrate how that unrecognized value still resides within Sandstorm. This first slide is really just pointing to the success of the investments that we've made so far. The first column, that's labeled 47 to 50,000 ounces, that represents our production guidance for this year. The second column illustrates in the first 3 quarters of 2016 the ounces that have been discovered attributable to Sandstorm through their streams or royalties on our assets. 84,000 ounces altogether, 63,000 ounces in the assets that are producing. So in that expected production of 47,000 to 50,000 ounces, already in the first 3 quarters, we've more than replaced the reserves on those existing assets, again, without us having to put out any capital for that exploration. The next thing I'd like to identify is really the development stage projects. We have 9 projects that we have royalties or streams on that are not in that previous cash flow forecast. These are assets that are well levered to the gold price, and in a higher commodity price environment, we could see these assets come online. And those assets represent 1.2 million ounces of gold equivalent resources attributable to us, and more cash flow on top of that, which I'll speak to in a few moments. The last thing is that taking aside those 21 cash flowing assets, a few of those development assets on top of that, we have another of these 90 exploration stage royalties. So these royalties are busy moving up the stage. Many of them have had a tremendous amount of money raised exclusively for their exploration. And as we go through this cycle, we certainly expect, not all of them, but a great deal of them to move up that stage from grassroots exploration to resource development and into feasibility type of studies. So that represents something that can add value in the future and growth in the future as well. And something that's very, very subtle, and I think a lot of people don't realize at all, is what we've been doing in the last several years is purchasing rights of first refusals and royalty buybacks. So in addition to the 133 royalties, we've done transactions with many Canadian companies where we've obtained their rights to buy back portions of the royalties. These are real, true options to be able to, for a fixed, already predetermined price, buy royalties up to 1% once we realize that there actually is some distinct value behind them and these assets are going to get into production. This is a slide which is trying to illustrate the transactions that we've done over the last 2 years. The reason we bring it up, because it is very indicative of, I think, the plan that we have in the future going forward for our acquisition strategy. You see some of these acquisitions like the Karma Stream for $30 million, the Diavik royalty for $52, the Yamana royalty for $152 million. These are really the core of where the bulk of our capital is deployed, in these good, solid, consistent cash flowing producers. However, beyond that, but the greater number of transactions have been on the higher optionality assets and packages of royalties. These ROFRs, some of these royalties, like the Alto Paraná royalty, we were able to roll in that asset into our company and roll it out to a purchaser for actually a net payment to us of $200,000, but we also retained a royalty going forward. The management team that we have is very creative. We work with a number of different venture capital groups in the mining industry based out of Vancouver. And so we see a tremendous amount of deal flow of all stage of types of projects in there. Any time we see something that we feel has got good value to it, or if it's a high quality asset, we try to come up with a good creative way to extract some sort of value to it, which gives us either a foothold or some kind of toehold onto a further or larger investment that's meaningful to our company. This is just really a quick array of some of the producing assets that we have in the portfolio so far. And you can see with the expected annual cash flow for many of these things, very significant. And some of the producers you can see, Newmont, Yamana, on some of these things, and Rio Tinto as some of the other producers. But I think what's even more interesting is to take a look at this development asset slide. Some of these projects that you can pick out. Hackett River, this is a project that we picked up a royalty for a value of equivalent around $4 million. This is a very, very high grade zinc and silver asset located in Nunavut in the hands of Glencore. When Xstrata was operating it, they were very active in developing this. Glencore is not so much. If Glencore or if somebody else decides to develop that, our royalty alone would provide us an estimated cash flow of $9 million. Per year. The Hugo North extension is part of the Oyu-Tolgoi complex. It's not the open pit that they have right now. It's the underground block cave area to the north. Our royalty that we own on this asset, once it gets into production, then there is a timeline for it to get into production, would provide us estimated cash flow of $7 million per year. So these are almost all items that are not currently in that cash flow chart that you saw earlier on in the presentation. So, where do we sit today as a company? We have zero debt. We currently have $20 million in cash available to us. And what that triangle that you're seeing on the bottom represents our cash balances as we see. So that's minus our G&A, minus any kind of tax we may owe on our assets. So the dashed line above that, though, represents the current revolving line of credit that we have available to us, which is undrawn at $110 million. So even today, we have the ability to go out and complete a $130 million transaction if we needed to. The column to your right represents a number of non-core investments that we currently hold as well. We have equity in a number of different companies, and we also have debt investments in a number of different companies. So this is not debt that we hold, it's debt that's owed to us from a number of different companies. This, over the next several years, we will work to liquidate, and that will give us further capital to be able to complete more transactions like we have in the past. For us, there is really kind of a clear pathway. As we start encroaching on $1 billion US market cap, we start appealing to a larger demographic of generalist type of investors. We've got a lot of those pieces in place, and we are getting precariously close to that magical $1 billion mark. We have the liquidity in the stock. We've always had quite good liquidity, but in the last year, as we've been added into a number of these indices, we've started trading at high volumes, up to $18 million US per day in the market. So for us, we feel we're really very well poised as an emerging royalty and streaming company to be able to start trading up towards the multiples that our peers are currently trading at. And for us, that really is the objectives. We want to do similar types of acquisitions as we've done over the last 24 months. We want to focus on those larger anchor assets, but still not forget about the optionality that comes at a very, very low cost in this market, using our creativity to be able to really develop a full set of assets that's going to help us trade at the proper valuations and similar valuations to our peers. So with that, that's all I want to talk about today. If you have any further questions, I'm available right now, and I'm also available after and before the lunchtime.
David, great presentation.
Thank you.
Step to the side here, and I'll just over here, on the stage. Are there any questions, ladies and gentlemen? Yes.
Approximately what percentage of the upgrade that you mentioned came from acquisitions versus new deals? When you talk about juniors to intermediates and seniors.
It's about half and half. So for instance, so 3 years ago, we really got 88% of our production from 4 assets. 2 of those assets were Santa Elena and Black Fox. And so those 2 were subsequently acquired by other assets. Beyond that, a number of other ones, like Lakeshore Gold, which we have a royalty on Thunder Creek in the 144, acquired by Tahoe. So a lot of these things have really been updated. I think of all the assets that we have originally done transactions on, really the ones that haven't been acquired at this point are the Arizona asset, which I think in the future probably has a high chance of getting acquired. Which leaves only really Bachelor Lake, owned by Metanor. And Metanor as well, it probably has the ability, because that's a good high-quality asset, potentially it would land in the hands of a larger company as well, too.
I'll keep it at that because I'm running late. But David, again, Thank you very much.
Thank you very much.
Okay. All right, our next company is Azimut Exploration. I have the honor of presenting Jean-Marc Dulin, who's the president and CEO. He's been president and CEO for the last 16 years. Jean-Marc is a veteran geologist, has made discoveries both in Quebec and in Western Africa. So Jean-Marc, I'm going to come and ask you to come and present Azimut Exploration, who is a prospector, and I insist the word generator. And so Jean-Marc, bienvenue.
Bonjour. Donc pour la dernière conférence de la matinée, la décision c'était de prendre le temps de faire une conférence en français, mais vous pourrez poser vos questions en anglais si vous le désirez. Donc Azimut est une société qui est spécialisée pour l'exploration minière au Québec. Alors, je vous exposerai en 4 parties pourquoi Azimut a décidé de se consacrer en exploration au Québec, pourquoi on explore au Québec, c'est quoi les avantages, faire un rapide sommaire corporatif, vous présenter les propriétés clés et ce que nous faisons en 2016. Au Québec, il y a essentiellement 3 facteurs d'intérêt pour explorer qui sont précisément identifiés. Le premier facteur, c'est que on bénéficie d'un immense territoire peu ou pas exploré. Le Québec, c'est en termes de superficie 40 fois la Suisse, 3 fois la France. Et les superficies qu'on peut considérer comme raisonnablement explorées au Québec, c'est à peu près 10%, 15% du territoire. Mais le grand nord du Québec reste un secteur où les investissements restent minimes, même s'il y a un potentiel géologique important. Le deuxième facteur d'importance, c'est qu'aujourd'hui, en exploration minière, pour avoir du succès, il faut travailler avec des données. On ne découvre plus les gisements par hasard. Le Québec a acquis au cours des 80 dernières années une immense banque de données géoscientifiques, une banque de données numérique qui est accessible au public. Ce sont des données publiques, très peu onéreuses, qui permettent, en les traitant de façon adéquate, de réduire le risque initial de l'exploration. Pour vous donner un exemple, on a une banque de données de sédiments de fonds de lac qui sont analysés pour 50 à 60 éléments par fond de lac. Donc c'est tout simplement de la boue qu'on analyse, qui est prélevée de façon systématique à l'échelle du Québec. Et ça donne une indication précise sur le contenu en métaux qui environne immédiatement ces lacs. Et c'est un outil extrêmement efficace pour aller chercher, pour aller dépenser de l'argent en exploration aux bons endroits. Par exemple, ici, on a une banque de données de 500 000 lacs qui ont été échantillonnés de façon systématique. Ici, on a une banque de données accessible, encore numérique, avec des analyses chimiques pour 1 million de roches. Donc on voit la localisation de ces échantillons à l'échelle du territoire. On a aussi une immense banque de données de forage. Il y a environ 25 000 kilomètres de carottes de forage disponibles que l'on peut consulter, qui sont archivées et qui permettent en fait de réduire le risque. On travaille avec des données, on ne travaille pas à l'aveugle. Également une couverture complète en géophysique aéroportée. La troisième raison majeure pour explorer au Québec, c'est qu'il y a une longue histoire minière. C'est une des juridictions qui est reconnue comme les plus favorables à l'échelle mondiale. Il y a des incitatifs fiscaux. Puis vous avez environ 150 mines qui ont été exploitées au Québec, une vingtaine en exploitation aujourd'hui. Puis ça reste un des leaders mondiaux pour le secteur minier dans le monde, avec une juridiction qui est évidemment très stable. Donc comment on peut définir nos activités? Comme vous le savez, il y a 2 risques majeurs dans le secteur minier pour les explorateurs. D'abord, techniquement, c'est très difficile de trouver des gisements d'envergure. Deuxièmement, ça coûte très cher. Donc la façon pour nous de mitiger, de réduire ce risque initial de l'exploration, c'est en 2 volets. La première chose, on s'y prend en traitant l'immense banque de données qui est disponible au Québec pour parvenir à définir des cibles qui ont la meilleure qualité possible, sur lesquelles les chances de découverte sont meilleures que la moyenne. Donc on se sert de cette immense banque de données géoscientifiques disponible pour identifier les meilleures cibles possibles. Donc c'est une façon d'avoir un edge, d'avoir un avantage par la capacité à traiter les données. Ensuite, en utilisant cette capacité à traiter les données, on acquiert les projets et on transfère le risque à un stade assez précoce à des partenaires qui vont prendre le relais au niveau de l'investissement. Donc pour nous, ça réduit notre risque d'affaires. C'est très important parce que le piège dans lequel tombent la plupart des sociétés juniors d'exploration, c'est la dilution à un stade initial avant d'avoir pu créer de la valeur. Donc pour éviter le piège de la dilution de votre capital action, vous devez absolument développer le partenariat avec des sociétés majeures ou avec d'autres sociétés qui sont prêtes à prendre ce risque-là. Et nous, on retient un intérêt dans ce cas-là sur les projets que l'on a transférés à des partenaires. Donc on adresse d'une part le risque technique et d'autre part le risque d'affaires. La compagnie a été fondée en 1986, donc il y a 30 ans, avec aujourd'hui 45,4 millions d'actions émises. Le capital action de la compagnie n'a jamais été restructuré, donc nous avons toujours conservé il n'y a pas eu d'agrégation d'actions, donc on reste très fidèle à nos actionnaires. Il y a 53,3 millions d'actions pleinement diluées, ça inclut des bons de souscription. Globalement, la structure du capital action, pour nous, c'est le meilleur actif que l'on a pour avoir le potentiel de créer de la valeur pour les actionnaires. Actuellement, il y a 54% des actions qui sont détenues par les principaux actionnaires. Dedans, on compte 15% d'initiés, 28% des grands fonds institutionnels québécois qui sont des actionnaires depuis le début, et environ 11% des actions sont détenues par 10 actionnaires individuels. Nous avons 2,8 millions de dollars en cash et pas de dette. Le management, puis le conseil d'administration, aussi, il y a une expérience très diversifiée dans le secteur minier, au niveau légal, au niveau de l'investissement. Sont des gens qui sont expérimentés en finance, évidemment dans le secteur minier. Puis donc c'est très fonctionnel. C'est un petit board. Vous avez aussi des gens qui sont situés, une personne qui est située à Vancouver, une autre à Toronto, et le reste du staff c'est Montréal. Ça nous donne aussi une compréhension des enjeux, de la dynamique du secteur minier à l'échelle canadienne. Maintenant, dans toute cette dynamique, qu'est-ce que l'on a fait au cours des 12 dernières années? Nous avons signé 30 ententes de partenariat, dont 10 ententes avec des compagnies majeures. Cela inclut 3 ententes stratégiques avec Rio Tinto, 2 ententes avec Goldcorp, 2 ententes avec IAMGOLD, 2 ententes avec Eclat Mining, et dernièrement une entente stratégique avec la compagnie gouvernementale du Québec, qui s'appelle SOCEM. Donc avec ces ententes, nous on a agi comme générateur de projets, et très tôt nous avons pu transférer ces projets à des partenaires, la plupart du temps majeurs. Il y a eu 66 millions de dollars qui étaient investis en exploration jusqu'à présent sur nos projets, dont 55 millions financés par les partenaires. Donc l'effet de levier, quand nos partenaires dépensent 5 $, nous en dépensons 1. Et donc c'est évidemment un transfert de risque, mais il y a une expertise aussi qui est partagée au niveau de l'exploration. Nous avons aussi un modèle qui est en partie un modèle d'autofinancement, où à travers ces ententes de partenariat, nos partenaires il y a des paiements d'options ou des paiements en actions, et ça couvre une partie de nos dépenses, de nos frais généraux. Donc 7 millions de dollars ont été reçus en paiement par les partenaires. Cette activité globale, au cours des 12 dernières années, a conduit à la découverte de 2 nouvelles provinces minérales au Québec, c'est-à-dire des vastes régions sur lesquels il y avait peu ou pas d'indices minéralisés reconnus. Donc nous avons ouvert de nouvelles régions, souvent de plusieurs dizaines, voire plusieurs centaines de kilomètres de long. La province, en particulier la province d'uranium de Lungava, qui est une région qui était inconnue pour son potentiel uranifère, qui fait 80 kilomètres de long. Puis ce qu'on appelle le corridor de Rex, le Rex Trend, qui est un corridor polymétallique dans le grand nord du Québec, reconnu sur 300 km de long. Et aussi incroyable que ça, c'est des régions immenses qui ont fait l'objet de très peu d'exploration. En 2 ans, nos équipes de reconnaissance ont découvert plusieurs centaines d'indices minéralisés qui éventuellement vont pouvoir être convertis en vraies découvertes minières avec des investissements additionnels. Et ça, on parle des années 2011 au Québec, où on peut encore découvrir des gisements d'importance, des prospects d'importance dans des secteurs qui étaient auparavant peu ou pas connus. D'ailleurs, Azimut a remporté le prix du prospecteur de l'année en 2011 par l'Association de l'exploration minière du Québec. Donc c'était une reconnaissance de l'industrie pour l'ouverture de ces nouveaux territoires. La région dans laquelle on concentre beaucoup nos efforts actuellement, c'est le secteur de la baie James, où une mine majeure a été découverte en 2004 par une compagnie junior, Virginia. Ce gisement a été acheté pour 500 millions de dollars par Goldcorp. Il est exploité depuis 2014. Donc nous avons acquis des propriétés dans le secteur de la découverte d'Éléonore, mais nous avons commencé à acquérir ces terrains. On a reconnu la valeur de ce secteur 1 an avant la découverte de ce gisement. Aujourd'hui, Azimut a une position stratégique dans les environs immédiats du gisement Éléonore, et on continue à explorer activement. On va y revenir dans un instant. Globalement, l'activité d'Azimut a conduit à la découverte de plus de 400 nouveaux prospects minéralisés à l'échelle du Québec, principalement pour l'or, l'uranium et pour les métaux de base. Donc cette diapositive vous présente la localisation de nos projets à l'échelle du Québec. La société détient le deuxième portefeuille minier en importance à l'échelle du Québec. Le premier, c'est détenu par Osisko. Nous avons 20 propriétés qui représentent une superficie d'environ 3000 km². Donc on voit les deux principales régions où nous sommes actifs, c'est la région de la baie James. Pour vous donner une idée, Montréal est situé ici, la ville de Québec est située ici. Donc on est à peu près à 1000 km au nord de Montréal, dans une immense région qui s'appelle donc la baie James, qui est une des régions minières les plus actives actuellement au Canada, principalement pour l'or. C'est une région en pleine émergence, justement consécutif à la découverte et à la mise en production du gisement Éléonore. Donc nous avons une alliance stratégique avec la compagnie gouvernementale Sochem dans cette région qui couvre environ 180 000 km². Puis là, nous voyons les propriétés actives d'Azimut dans cette région. Nos autres actifs, c'est situé dans le grand nord du Québec, dans une région que l'on appelle le Nunavik. Le Nunavik, ça commence au 52e parallèle, à peu près ici, et ça couvre une superficie comme la France, sur 500 000 km². Donc c'est vraiment immense. Le Rex Trend dont je vous ai parlé il y a un instant, ça couvre 300 km². C'est constitué par ces trois propriétés, Rex Sud et NCG. Donc on parle vraiment, c'est les nouvelles frontières de l'exploration au Canada, et on prépare les prochaines générations de découvertes, je dirais au Canada et en particulier au Québec. Ce qui est intéressant pour que vous puissiez bien voir un peu l'immensité de cette région. Donc c'est la superficie de la France, mais sur cette superficie, il y a seulement 10 000 habitants qui habitent, dans 14 villages qui sont essentiellement répartis autour de la côte. Donc ce sont essentiellement des Inuits, population locale, qui est très en faveur des mines. J'aurais dû peut-être le situer, mais vous avez une mine majeure ici qui est opérée par Glencore. C'est une mine, c'est la mine Raglan, qui exploite cuivre, nickel et platinoïde. Donc même si c'est très nordique, les conditions d'exploitation au Canada, il y a une expertise qui est en train de se développer pour développer des gisements et exploiter des gisements en conditions extrêmes. Donc, il y a un instant, je vous disais que la société a contribué directement et avec ses partenaires à la découverte de plus de 400 nouveaux prospects à l'échelle du territoire. Donc, ces prospects sont localisés. Évidemment, il y a certains de ces prospects, on est convaincu, ça pourrait être converti avec l'aide des partenaires, avec des investissements additionnels en vraie découverte minière. Et le secteur où Ah oui, c'est éteint. Merci. Donc la découverte de Chitous est située à proximité immédiate du projet Éléonore Sud, donc c'est vraiment en continuité de notre projet. Comme vous le verrez, il y a des cibles à haut potentiel sur ce projet qui est détenu avec 3 partenaires, donc Azimut à 26,6%, Goldcorp 36,7% et Eastmain 36,7%. Donc aucun des 3 partenaires a un pouvoir décisionnel, donc ça oblige une bonne collaboration entre ces 3 partenaires, et la collaboration est effectivement excellente avec nos 2 partenaires. Azimut est également l'opérateur sur le projet. Donc le projet Éléonore Sud est situé ici. La mine Éléonore est située à environ 8 km de la bordure du projet, donc c'est cette mine exploitée par Goldcorp. Et Azimut a par ailleurs une implantation stratégique immédiatement autour de la mine Éléonore. Ce projet est également en joint venture avec Éclat Mining, qui investit 100% des fonds depuis plusieurs années pour faire une découverte sur cette propriété. Donc le secteur Éléonore Sud, qui nous occupe beaucoup en ce moment, est situé ici, puis on se concentre essentiellement dans la partie est de la propriété. Alors cette zone cible principale fait environ 14 km². On a un programme de 5000 mètres de forage qui est en cours. Il y a 50% de ce programme qui a été déjà réalisé. Puis les cibles sont déterminées par l'analogie de la signature du gisement Éléonore. Le gisement Éléonore ressort comme présentant une très forte anomalie en or et arsenic en surface, dans les sols. Donc évidemment, c'est une mine souterraine, mais en surface, dans les sols qui ont été échantillonnés de façon systématique, il y a vraiment de fortes anomalies en or et en arsenic, ce qui est tout à fait logique. Et sur le projet Éléonore Sud, on a une signature qui est comparable en intensité, mais aussi en dimension, à la signature du gisement Éléonore. Donc, par analogie, on en déduit qu'il y a une cible qui est d'envergure comparable. Les travaux qui ont été réalisés cet été ont permis de découvrir de nouveaux prospects qui sont intéressants. Les meilleures teneurs que l'on a eues en rainurage, en échantillonnant directement la roche en surface, c'est 49,2 grammes par tonne sur 4 mètres, sur un nouveau prospect qui a été découvert dans ce secteur-là cet été, et un résultat de forage de 76,1 grammes par tonne sur 1,55 m. Puis la distance entre ces 2 prospects, c'est de 600 mètres. C'est complètement ouvert, ça n'a jamais été foré, très peu échantillonné. Donc on pense qu'on est potentiellement dans une phase de découverte, qu'on commence une phase de découverte sur ce projet. Et les forages additionnels qui seront réalisés début 2017 espérons-le, vont prouver ce point-là. Mais c'est une zone cible qui est d'envergure, qui présente beaucoup d'intérêt, qui présente des analogies avec le gisement Éléonore. Globalement, sur le secteur Éléonore Sud, on a une zone cible prioritaire qui fait 10,3 km de long, puis qui est essentiellement liée au contact entre une zone granitique ici, qu'on appelle tonalite, enfin c'est une variation de granit, et des sédiments ici. Donc ce qu'on voit ici, c'est les très très fortes signatures en or et en arsenic dans les sols, mais également le contact est une zone cible qui est encore très peu forée. Donc la zone sur laquelle on priorise l'exploration actuellement, c'est ce 14 km² qui se situe dans le granit, dans la tonalite, et sur lesquels nous avons eu de très bons résultats. Donc là, on a un détail de cette région. C'est une diapositive qui représente un plan avec la découverte de Chichou, donc sur la propriété adjacente. Et ce que l'on a, ce qu'on définit, c'est un corridor prospectif qui fait environ 3 à 4 km de long, 500 mètres de large, donc, qui est défini dans un granit, mais sur lequel on a découvert tout au cours de la première phase de campagne de forage et de prospection de très nombreuses valeurs aurifères qui pourraient, avec des travaux additionnels, conduire à la définition de ressources. Un autre exemple de projet majeur situé dans le Grand Nord du Québec, cette fois-ci, c'est le projet Rex Sud. C'est un projet polymétallique d'envergure. L'analogie, le type de cible que l'on regarde, c'est encore gisement polymétallique, dominante aurifère. Le principal analogue que l'on voit en termes de gisement, c'est Dunlin Creek. Ce gisement, c'est situé en Alaska, c'est beaucoup plus avancé que le nôtre, évidemment. Mais il y a beaucoup d'analogies entre ce type de minéralisation à Dunlin Creek et le type de minéralisation que l'on a dans ce projet. Pour vous donner une indication encore de l'envergure des cibles, on parle de cibles majeures qui correspondent potentiellement à la signature de camps miniers qui ouvrent de nouvelles voies, de nouvelles régions à l'exploration minière. Cette zone cible fait 15 km de long par 5 km de large. Et en 2 ans de prospection, on a trouvé plusieurs centaines de prospects minéralisés d'envergure avec des teneurs intéressantes. Puis maintenant, c'est un projet qui est prêt à forer. Pour le moment, il y a eu 18 zones minéralisées qui ont été découvertes simplement par la prospection de surface. Ça donne une longueur cumulative de cible de 57 km. Donc c'est pour vous dire, c'est les secteurs, quand on arrive dans ce type de région, d'abord la région a été déglacée il y a 8000 ans, ça veut dire avant c'était couvert par des glaciers, donc les hommes préhistoriques qui existent depuis 100 000 ans ou 200 000 ans en Europe, si ces hommes-là existaient à l'époque, ils marchaient sur de la glace, ils ne marchaient pas sur la roche. On peut marcher sur de la roche depuis 8000 ans. Ça veut dire que c'est très récent. On a vraiment un modelé glaciaire. Ça vient juste de fondre et on marche sur de la roche, sur des secteurs qui n'ont jamais été marchés par des humains. Jamais. Il n'y a pas de traces humaines dans ces secteurs. C'est des secteurs complètement vides. La population est le long des côtes. Donc ce territoire est complètement ouvert à l'exploration. Et c'est absolument fascinant parce qu'il y a très peu de régions dans le monde où on peut faire des découvertes comme ça en surface et avoir la perspective de trouver des gisements majeurs comme ça à fleur de terre. C'est vraiment intéressant pour ça. Une autre propriété qui est située dans le même contexte, c'est le projet nantais. C'est un projet or, argent, cuivre et zinc. L'analogue, c'est des gisements d'Abitibi, c'est des sulfures massifs volcanogéniques à haute teneur en or. Notamment dans l'Abitibi, il y a un gisement important qui s'appelle, c'est la mine La Ronde, détenue par Agnico Eagle. C'est un gisement vraiment célèbre qui fait rêver tous les gens de l'exploration. Puis sur le projet nantais, on pense avoir une cible d'envergure comparable. Pour le moment, nous avons là encore une zone cible qui fait 18 km en longueur cumulative avec d'excellentes valeurs trouvées en or jusqu'à 26 grammes par tonne, trouvées en surface. Puis c'est un projet, là encore, qui n'a jamais été foré, mais c'est prêt à forer. Pour vous donner une idée, la largeur de cette zone-là, c'est environ 900 mètres. Cette zone cible centrale, c'est 3 km. Ça a été trouvé avec 2 étés de terrain, simplement en marchant sur la surface de la roche. Donc la perspective pour 2016, le programme a été en grande partie réalisé. Le budget d'exploration pour la société, c'était 3,3 millions. Sur ce 3,3 millions, selon notre modèle d'affaires, il y a 75% qui a été financé par les partenaires. Donc c'est vraiment notre modèle d'affaires. On génère des projets, nos partenaires investissent, et nous, on investit une partie de cet argent, évidemment, dans certains cas. Donc sur le projet Eleanor Sud, il y a un budget pour l'année 2016, mais qui va se poursuivre en 2017. C'est 2 millions de dollars. Azimut agit comme opérateur. Sur le projet Opinaka B, qui est situé immédiatement à côté du gisement Eleanor, il y avait un investissement de 800 000 dollars financé à 100% par Hecla Mining, et cet investissement va se poursuivre en 2017. Nous avons une alliance stratégique dans la région de la baie James. SOCEM met 100% des fonds, donc SOCEM c'est la compagnie gouvernementale, Azimut agit comme opérateur, puis d'autres projets sur lesquels nous investissons directement. Donc la société a investi 250 000 dollars sur un ensemble d'autres projets. Puis nous avons évidemment d'autres projets qui sont disponibles pour des partenaires majeurs. Quand le cycle va reprendre, il n'y a aucun doute que ce cycle va reprendre, nous allons avoir des développements, de nouvelles ententes avec des partenaires dans le Nord. Donc la 30e entente que nous avons signée en septembre, c'est très certainement pas la dernière. Donc en conclusion, on a un projet qui est probablement au stade de la découverte, ou proche du stade de la découverte, c'est Eleanor Sud, où on a de la minéralisation aurifère avec des hauts teneurs reliés à une intrusion. Puis il y a un programme de forage qui est en cours avec une coparticipation de Goldcorp et de East Main Resources. Donc essentiellement, pour revenir au modèle d'affaires, on utilise notre capacité en traitement de mégadonnées pour générer des projets et pour développer le partenariat. Nous avons une position stratégique à l'échelle du Québec dans plusieurs camps miniers potentiels, en tout cas à très haut potentiel de découverte en surface. Puis ce qui garantit finalement, c'est pas une garantie, mais ce qui donne des chances à la création de valeur pour la société, c'est la structure de son capital action, où à travers les cycles, nous avons démontré notre capacité à avoir une attitude très disciplinée pour éviter la dilution. Donc finalement, tout ce qui oriente la stratégie de la compagnie, c'est une stratégie pour minimiser le risque avec des faibles dépenses, un très faible investissement de la part d'Azimut directement, mais potentiellement avec un fort effet de levier. Donc je vous remercie.
Merci Jean-Marc, excellente présentation. Thank you Jean-Marc, excellent presentation. It is the lunchtime, c'est l'heure du déjeuner. Donc you're welcome to just cross over here the hallway and we'll continue at 1 o'clock, so in a couple of seconds. Merci pour votre présence, mesdames et messieurs. 5 minutes de plus, mais c'est pas grave. Puis j'ai adoré ça en français.